more. And all around, it seems like bigger companies are just consolidating their market share.
So that's a great question. So consensus seems to have moved down the cap scale. What we're saying here is we like U.S. versus international, both developed international and emerging markets. We think we're in a strong dollar regime, so that is not great for emerging markets. China still seems to be unable to stimulate its economy to the extent to really pick up the emerging markets complex there. So we'd like U.S. over rest of world. Within the U.S., I think you can allocate more to medium and small size, but we still like U.S. large cap here precisely because of what you're talking about, which is U.S. large cap companies with the cash flow have better levers to deal with some of the tariff issues than small cap companies. So yes, on the index level, small caps have caught up and they've done great. Going forward, I think the policy mix is such where I think the large caps do better. And let me just say this, we've talked about the Magnificent Seven and large cap tech, which has not driven the market since the Fed pivoted back in July when they signaled that we're in a rate cutting regime. The rest of the market caught up. If you have those risk off days, which sector is going to act as defense? And that is large cap tech. So I think you dismiss it. It will provide stability in the portfolio in a way that small cap may not. And that's why we are still over allocated to U.S. large cap, but we like the whole U.S. complex here over rest of world.
When you look at risks to the market, you rate energy prices are risk, but WTI even this morning is below $70 a barrel, even though we have issues going on in conflict in the Middle East. What worries you?
So it's not that it worries me, it's the key variable to all of this, right? So when our clients say, wow, the world's a scary place, I mean, and also just think about what happened yesterday. We have France, we have South Korea. This was on nobody's radars for the most part. How does geopolitical risk get mediated into markets? And it's typically through the oil channel and the energy channel. So that's the variable you want to look at. We don't think there's a risk here. I think not just the deregulation in the U.S., but clearly I think some deals that may happen in the Middle East, this administration wants to see oil prices lower. That's great. It's not a certainty. And so, when everybody's on one side of the boat, you just want to keep an eye on where you could go wrong, because where you could go wrong is where the consensus is. So just keeping an eye on that.
You just gave a nod to all the political instability we're seeing. South Korea, France, Germany. Does this mean you want to double down even more on the United States?
So I wouldn't say we're doubling down because we've been there. So we've been there for 2 years. We've been overweight U.S. for 2 years. We had taken down our exposure to international and both developed and emerging markets 2 years ago as the Fed was hiking rates, because our feeling was, even if we're going into a recession, where do we want to allocate our client capital? And that is in the U.S., so we're there. I'd say what interests us here is going a little bit more down the cap scale, but still overweight U.S. large cap. So in our 2025 outlook, we talk about how we still like where we've been. We're going to probably allocate more in the new year there.
6,600 on the S&P for year-end next year. Alicia, it's good to see you. Thanks for being with us.
Thank you.
Alicia Levine there of BNY. Equity futures up by 1/3% with some stories elsewhere. Your Bloomberg Brief is Danny Berger. Hey, Danny.
Hey, John. French President Emmanuel Macron is asking lawmakers to reject a no-confidence vote that would topple the government. Far-right leader Marine Le Pen and her National Rally Party have vowed to support the motion submitted by a left-wing coalition. It will pass if backed by both groups. Lawmakers will debate and vote on the motion in less than 3 hours' time. Democrat Adam Gray has won California's 13th congressional district, unseating Republican Congressman John Duarte. It's the final House contest to be called this year. Gray's victory brings Democrats to 215 seats. Republicans hold 220. Gray reportedly won by less than 200 votes. General Motors will take on more than $5 billion in charges and write-downs tied to its troubled operations in China. The automaker is attempting to save its once profitable business in the world's largest car market. According to a filing this morning, GM expects to write down the value of its JV operations in China by as much as $2.9 billion. It will also take another $2.7 billion in charges for costs to close factories and restructure its operations in the country. And that's your brief. John.
Hey, Danny, thank you. More from Danny later this hour. Up next on the program, pushing Trump's agenda.
While you may see some of these tariffs increase maybe marginally kind of day one, that there will be, they'll try to do it sort of in concert with some other things that are, maybe more risk on in terms of the tax cuts, in terms of, deregulation and what have you.
We'll get to the sequencing of that policy effort in just a moment. Live from New York City this morning. Good morning.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
An update from JetBlue. Stock is up in a pre-market by 2.6%. The airline giving you some additional clarity on the fourth quarter, raising the outlook. Lisa, you're going to have to explain this one. The election headwind. What is the election headwind?
So basically, in the weeks leading up to the U.S. election, pretty much every travel company, hotel company, et cetera, said that people didn't like to travel. Try to explain this, go figure why people suddenly think that the uncertainty of the election somehow make them stay home. Nonetheless, basically, there was a restraint in travel, so that was the headwind. But then the revenge travel after the election, they said that booking performance for travel in November and December was higher than expectations immediately following the U.S. election, because that's done. Okay, now we can go travel.
Okay, that makes sense. Kinda. The stock is up in a pre-market by about 3% following that update. Under surveillance this morning, pushing Trump's agenda.
The economic direction of travel here's a little bit mixed. What we understand from the Trump transition team is that there is going to be attention to the sequencing of various economic policies. So while you may see some of these tariffs increase maybe marginally kind of day one, that there will be, they'll try to do it sort of in concert with some other things that are maybe more risk on in terms of the tax cuts, in terms of deregulation and what have you.
So here's the latest on that sequencing. Incoming Senate Majority Leader John Thune looking to pass a budget reconciliation bill early next year, focusing on border security, defense and security. Thune telling Senate Republicans he wants to postpone a tax-focused bill until later in 2025. John Lieber of Eurasia Group joins us now for more. John, you heard there from Libby Cantrell of PIMCO just moments ago, talking about the word tension. Can we ask you, how much tension there will be over this between Mar-a-Lago and Capitol Hill?
Well, on the legislative agenda, they're united. I mean, this is not unusual that, a president comes in and he's got unified Congress. We've seen it with Biden, Trump, Obama, and Bush now. And in that combination, when it happens, they tend to come in with the head of steam and they get big things done. Bush did a big tax cut. They did education overhaul with Democrats. Obama did a big stimulus bill. He did healthcare. He did financial sector reform. Trump did a big tax cut. Biden did a big stimulus bill. And these things can happen really fast. Republicans are united around the elements of the Trump agenda they support, mainly immigration, energy, higher defense spending, extending the Trump tax cuts. And, you know, it could move quickly because the politics at the big level aren't that high. At the high level, they aren't that strained. But when you get into the details is when things get really hard. And that's what ends up delaying an agenda like this, I think, probably to later in the year.
But is that why potentially you have immigration first out of the gate, John Thune wants to do in the first 30 days and wait on tax? Because you think there's going to be more of a discussion and negotiation when it comes to tax cuts?
I think the challenge with the tax cuts is the cost. And, you know, $4 trillion to extend the Trump tax cuts that expire at the end of the year, it's not nothing. And they just haven't come to terms with how much of that they need to offset with other spending cuts. You know, the other plans they have for the border, for defense, these are probably in the low, mid tens of billions, maybe in the hundreds of billions of dollars of a 10-year cost, which is how Congress budgets things. But the tax bill is real money. I mean, these are trillions of dollars. I think they probably end up not offsetting it, but it's just clear they haven't had that discussion and they don't know exactly what they want to do on the tax side. I think that makes it a little more difficult, whereas these other issues are a little easier. Honestly, I'm a little surprised at the sequencing. I would have thought tax is something they basically agree on, keeping current law where it is, making sure nobody gets a tax increase. That should be pretty easy for Republicans, but the fact that they're talking about delaying it suggests there's more dissension among them than is obvious.
When it comes to paying for that tax bill, is it going to be the tariffs, or do you view the tariffs as potentially a lot of bluster at first, but they're going to end up being a negotiating tool?
I think tariffs will be higher. Trump has said he's going to raise them. He's already kind of laid out a plan for 3 countries to raise them on: Mexico, Canada, and China. But it's interesting, if you look at those 3 countries, Mexico and Canada came immediately down to Mar-a-Lago to sit down with Trump and probably will end up finding a way to negotiate out of those tariffs, whereas China's taking a more of a wait-and-see approach, which could mean that those tariffs end up being the ones that are implemented on day one. So, I think the tariffs are both. They're both a negotiating opportunity, but they will be higher by the end of next year. We just don't know how much. And if it's significant, then that gives, if it's hundreds of billions of dollars over a 10-year period, which I don't expect, but if it is, that gives the Republicans in the Congress an opportunity to use that revenue to offset the tax cut. And if it's smaller, then they have to ask themselves, how much of a deficit hit are they willing to take?
John, when it comes to this raw power we see Donald Trump use right now, whether or not it's already negotiating tariffs with the likes of Justin Trudeau, or also reiterating that he would kill the Nippon Steel, U.S. Steel deal, what does this mean for President Biden when it comes to not just the outreach on foreign policy, but this deal right now that remains in CFIUS control?
Well, it means that Biden's term has ended 2 months earlier than expected. And I think, Trump's clearly the person that world leaders want to talk to. Biden doesn't, Biden could do a couple of interesting or significant things between now and the end of the year. They're pushing for additional funding for Ukraine. You could see maybe several $billion keep going to fund that war effort. Biden could approve the Nippon Steel deal. We don't think he will, but he might. Trump has reiterated, this is an influx issue because the unions are starting to get more worried about losing their jobs if the deal doesn't go through due to the lack of money that U.S. Steel has coming in. And Biden still has the power to save that if he wants to. It would surprise me. That would be an unexpected kind of parting shot at the organized union labor that supported him during the campaign. Some of them supported him. But it's still in his power if he wants to do it. I just don't think he will.
John, on a broader level, right now the market has moved on, as you've talked about. People are looking to Donald Trump as the president-elect, or the president even, as they have some negotiations. And there seems to be this euphoria around policy certainty. At the same time that a number of nominees that Donald Trump has put out there have already stepped down. I'm talking about Pete Hegseth, that's the latest, potentially from the Wall Street Journal, that might be. Matt Gaetz was the first. How much do you think that people in the market are overstating how much of a well-oiled machine this actually is and how much policy is actually going to get through?
Well, I think on the things that matter, there's a little bit more certainty, right? So the big things that are going to move the markets next year are probably going to be immigration, tariffs, and fiscal. Fiscal is going to remain loose. Immigration numbers are going down, and on tariffs are going up. So we know that, but what we don't know is the magnitude. And I think that it's still possible and probably likely the magnitude of each of those things ends up being higher than anticipated. On fiscal policy, yes, it'll remain loose. I don't think there's big tax cuts coming. The immigration numbers could be big. It won't come as a shock, like a one-time shock to markets, because you're not going to be deporting 10 million people all at once. But there will be this slow drip in the labor market as it tightens next year, as they get to somewhere around 1 million people being deported per year, is our guess. And then on tariffs, that could be a bigger shock than anticipated right now. I think the fact that Trump seems to have put in place a more market-friendly cabinet is probably allowing market participants to think that this is probably not going to be as bad as it looks. But tariffs are Trump's favorite tool, and directionally they're going up. That shock is probably the one that could be the largest next year that's not priced in right now.
Just quickly, John, will the Trump administration have the finances to do these mass deportations?
Yeah, I mean, this is one of the reasons Thune wants to move quickly on immigration, is because they're going to be able to give significant, probably tens of billions of dollars in additional resources to the southern border, to CBP, and to others to help with the deportations. There's going to be a lot of pushback. They've got to detain a lot of people. They've got to find a lot of people. And they're not, in some states, they'll get cooperation from local law enforcement, and others they won't. So that effort's going to be messy. But, 500,000 people deported a year is not that unusual in recent U.S. history. And I think it should be pretty easy for the Trump team to get there next year and go beyond that in 2026.
Hey, John, it's good to hear from you. As always, sir, thank you. John Lieber there of Eurasia Group on the sequencing for next year and the little bits of tension here and there. And the fact you might have to wait for that tax cut. Look, the Tax Cut and Jobs Act of 2017, you extend that, it's expensive enough. What about everything else? Taxes on tips, SALT deduction, all of the above.
The extension isn't actually a tax break, though. That's what we're learning. That's just simply instating the actual policy that exists. So maybe a marketing quirk can allow some of those tax cuts to disappear.
It's a lot to figure out in the next 12 months or so. Up next, we'll catch up with the former senior U.S. intelligence official, Norman Rule.
The countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
only on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
We are 2 hours away from the opening bell. Equity futures right now adding some more weight to this year's rally. Up another third of 1% on the S&P 500, up 0.6 on the Nasdaq 100 with your morning movers. It's Manus Cranny. Good morning, Manus.
Jonathan, good morning. Pump up the margins, pump up the revenue. That is the message from Salesforce this morning. Your CRM provider with a sprinkling of AI. It is the magic words. The revenue is up over 8% at $9.44 billion, but margins 33.1%, and a message from the C-suite. Good number of deals signed on the Agentforce, that is their AI product. Piper Sandler liked the message so much that they've upped the game to $405 on the stock from $395, and they say this is a robust multi-cloud adoption. Have a look at Big Pharma. We've got a lot of political issues going into 2025, but Merck is worth just taking a note of. It's been upgraded by HSBC, $130, so there's 28%, 30% left in the upside. What they say is the valuation at the moment leaves a significant margin for safety, and also one of the big drugs that they have, one of the big cancer vaccines in China, as they say, is stabilizing, and you need to take note of that. Everybody hopes that the great adventure in China will reap great rewards. Mary Barra has decided to be very pragmatic today. She's taking a hit on the joint venture in China. That's SAIC, 50-50 joint venture. It's going to cost them $2.7 billion to close factories, to restructure, and to deal with the reality that Mary Barra says, which is domestic brands in China are not prioritizing profitability, Jonathan. There's no shock there. They prioritize production, market share, and the full backing of China, and that is the differentiating factor here in terms of the adventure, the misadventure, and the cost of pain of doing business in China. Good morning, Jonathan.
And emerging national champions at that. Manus Cranny, thank you. I think Jay Poloski coined the phrase the tripolar world when he started to think about these issues, and we're seeing that across the board for the auto manufacturers in places like China, in Europe, in the United States. They seem to be retreating to home base. And in certain places, the United States, for example, the government is very comfortable with that. They're just willing to put the walls up and protect them at the same time.
So which industries are able to go to home base and can sustain themselves on local production, and which can't? And this raises the question about the likes of Apple. It raises the question of other companies, Qualcomm, that have been really interlaced with Chinese production and just sales in general. It becomes a real big question as we talk about decoupling at a time where the two biggest economies in this world are intricately connected.
So I think there is one home base that's better than others, and that's the United States of America. If you have to retreat to America, that is a good thing. If you have to retreat somewhere else like Europe right now, with the economy not doing so well, very different proposition.
Which raises the question about GM and the fact that, as you pointed out, their shares are up some 50% so far this year, at the same time that you have the likes of Volkswagen and Stellantis absolutely being hammered because they're facing a 1-2 whammy, where essentially in China they have a competitive disadvantage, and in their home market they don't necessarily have the ability to sell as much as they're producing.
Let's get to some other company stories. Under surveillance this morning, the latest on retail. Foot Locker cutting its full-year sales and profit forecast, citing more discounts and a pullback in consumer spending. This is Dollar Tree reports better than expected earnings, also announcing the departure of CFO Jeff Davis. That stock is up by 3%. But just to get back to Foot Locker in the pre-market, Bramo getting hammered.
Yeah, at a time when Foot Locker's been trying to turn itself around after, remember, trying to move away from some of the big brands, the Adidas and the Nike, and that didn't really work. So now suddenly they are trying to rejig bigger. But what this highlights to me is you're seeing market share cannibalization, and you're seeing that become more and more entrenched, and the winners and the losers are becoming much clearer. And I think that that's fascinating at a time when, frankly, you can't make a big macro story out of one name, especially one that's been struggling for a while.
Well, when you look at the CEO statement, they talk about this more cautious view because there's a more promotional environment and softer consumer demand outside of key selling periods. What's more key selling period than up until the Christmas holiday season? This is when they should be doing well, and they're seeing a pullback ahead of December, ahead of, Christmas, Hanukkah, Thanksgiving. It's pretty incredible, and you have to think, how's 2025 look?
Elisa alluded to this. This has been a problem for a while over the last several years. Nike was a key partner. They deprioritized retail partnerships like the one with Foot Locker. That hurt them. There's been a lot of volatility in this name. I think we always take a step back for the retail players and we think, does it tell me something about the consumer or execution? Is it one or the other? And I think, Lisa, that's what you're getting at.
Especially with the juxtaposition of Dollar Trade. I know they're completely different companies, but we saw some retailers do very well. We saw TJ Maxx do very well. We saw Gap do well. We saw a whole host of names come out with better than expected earnings and consumers that were anything but particularly cautious. With Foot Locker, I think that you're onto something, and you're seeing this dramatic shift with, do some of the brands sell direct to consumer? How much do they need the platforms? Where do they need the stores? And I think that that really is where this story lies.
Foot Locker down double digits in the pre-market trading so far. We're down about 14%. Let's turn to the politics. French President Emmanuel Macron calling on lawmakers to reject the no-confidence vote that could topple the government. The right-wing National Rally Party vowing to support the motion submitted by a left-wing coalition in response to Prime Minister Michel Barnier's unpopular budget bill. France isn't the only place where you're seeing instability. In South Korea, the opposition party calling for the impeachment of President Yoon after he briefly imposed martial law. Opposition parties saying they'll also pursue treason charges against Yoon, and the defense and safety ministers alleging the declaration of martial law was illegal.
So there's a lot of political instability around the world. And I think what's so interesting about South Korea is actually this was working with President Yoon. Remember, this was the president that came to the United States and was singing American Pie at the White House for a state dinner. They were able to work on trilateral engagement between South Korea, Japan, the United States. This was a foreign policy achievement. And now this individual is going to be facing impeachment charges.
Well, all I can say is he miscalculated on every level you could possibly imagine. He came out and said, this is it, military rule, no fake news, stop reporting anything on politics. And reporters were like, whatever. And they continued to actually get a consensus against him pretty much across the board. Just not to find some silver lining, but if anything, maybe the takeaway is no way are people going to accept this in South Korea. On a larger scale, this might actually mean a more friendly relationship with North Korea, which has more geopolitical consequences. But in the short term, it doesn't seem like this is a democracy about to be toppled.
Well, the reason why he had martial law, if you look internally at their politics, you get a 5-year term as president, and he's due in 2027. And he's been trying to enact change, get legislation through, and he hasn't been able to do it. The only way he could potentially get some of the bills he wants through was to have martial law. So he probably felt like, I'm just going to take this gamble, see if I can even get a bill, one through, but it backfired in a grand scale.
Lasted about several hours? 6 hours. Some volatility once again over in South Korea. Let's get to some real volatility in the Middle East. AP reporting Israeli forces carried out several drone and artillery strikes in Lebanon yesterday. Israeli Prime Minister Benjamin Netanyahu saying Israel is enforcing the Lebanon ceasefire with an iron fist, acting against both serious and minor violations from Hezbollah. Joining us now, Norman Rule, the former senior U.S. intelligence official. Norman, welcome to the program, sir. In your experience, are things like this, breaks in the ceasefire, episodes like the one we're seeing play out overnight, are they normal or is this out of the ordinary?
Good morning. The ceasefire between Hezbollah and Israel was expected to be shaky. It continues to hold. It is a ceasefire of sorts in that you have Hezbollah and Israel each launching limited strikes against each other. The United States remains displeased, along with the French, with Israel because it is not using the system that was set up to address Hezbollah violations. But the Israeli posture on the region has changed. It's not going to rely upon what it believes to be a slow and ineffective international community. activity, and it will, if it sees activity by Hezbollah, it will attack that activity before Hezbollah is able to build positions, move in weapons, etc. I think this is going to be a bit of the new normal for this ceasefire for a while, until each side is able to basically test the other's limits, and the Lebanese government is able to place its forces in the south to separate these two sides.
Norman, when it comes to what is going on in Gaza, we have President-elect Trump and President Biden both saying the hostages need to be released. Has Hamas shifted its position at all for there to be any opening in a ceasefire agreement?
No, Hamas's position has remained consistent. It has called for the withdrawal of Israeli forces from Gaza, the withdrawal as part of that of Israeli forces from the Philadelphia corridor along Egypt, where tunnels had existed to allow Hezbollah to move personnel and weapons in and out of Gaza. And last, that Hamas have no restrictions on it as to where it can move its forces inside. For Israel, in essence, this means losing the war, Hamas restoring its control over Gaza. At the same time, within Israel itself, the Israelis continue to believe a military option is important and the way to go in Gaza. There is some evidence they're setting up military installations in the north, and the U.S. has complained about this. I don't see a significant shift taking place in Gaza in the near term.
I also want to ask you about what's going on in Syria. How weakened will Iran be, and their proxies, whether that's Hamas, Lebanese Hezbollah, if Iran loses its stronghold in Syria?
The loss of Syria for Iran would be catastrophic. Syria is Iran's only state ally. It has been a decent partner for Iran since the days of the Iran-Iraq War, and Iran requires the territory of Syria in order to shift weapons into Jordan, shift weapons via Jordan into the West Bank, and of course to provide training and weapons flows into Lebanon. Last, Iran is able to use Damascus as an air hub, so it brings militants, to include the Houthis, to Syria, puts them on a plane in Damascus, sends them to Iran for extensive training and ideological vetting. So the loss of this territory would be a significant pressure on Iran's entire proxy architecture.
Norman, is there a takeaway that it just took days for rebels in Syria to topple some of the Assad regime in key cities after years of fighting, after the removal of the pressures of Iran, but also with Russia? It's sort of a perfect storm of the Ukraine-Russia war, as well as what's going on with Israel and Gaza and Hezbollah. How much is this just the beginning of a certain percolation of other conflicts in regions that have essentially been hosts to proxy wars between Iran and Russia and the West?
A great question. So what we've seen in Aleppo is that the Russians, the Iranians, and the Syrians each suffered a significant intelligence failure. They did not see Hayat Tahrir al-Shams, the opposition group that took Aleppo, prepare for this attack and infiltrate the city. Right now, the rebels have moved, or the opposition have moved south, and they're now pressuring Syria's fourth largest city, Hama. Hama and Homs, about 24 kilometers south, are critical to maintain the connection line between Damascus and Russian bases on the Mediterranean. What you're looking at is a system that is eroded, not just in intelligence, but in its response capacity. Russia is now responding traditionally with airstrikes, to include reportedly on hospitals, much as it did in the past. You're going to see Iran move personnel and weaponry, shift its Afghan and Pak militias in Syria, and bring in elements of Iraqi militias into country as well. But what you're not going to see is a large Hezbollah portion from Lebanon. We're seeing a region that has changed. I would caution that it was too early to say that the Assad regime is going to collapse, or that the Quds force in Iran is going to lose its control of Syria. These are early days in this conflict.
That said, Norman, the fact that you're seeing this sort of rejiggering in political force in the Middle East comes at a time that we're talking about developed markets struggling with government dissolution, whether it's from South Korea and what that means for North Korea, whether it's France, what that means for the support of Ukraine. What are the hotspots you're looking at to potentially be new nodes of conflict as you do see this political turmoil around the world and a changing in the geopolitical order?
Yemen remains the most prominent potential hotspot. The Houthis have maintained their architecture. They are available for Iran to replenish, retrain, and reposture. They are geographically located on a major trade outlet, the Bab el-Mandab, and they're able to threaten the prosperity of the Gulf Cooperation Council with missile and drone strikes. Yemen is a problem that the world has ignored, and I believe it will pay the price for doing so in the future. In terms of Syria, Lebanon, perhaps Libya, and other the broken states of the region, we're seeing more of the same. I would say that you're watching the Saudis, the Emiratis, continue their efforts to see if they can pull Assad from Iran into the Arab fold. This is difficult. And last, you are seeing the Gulf Cooperation Council, particularly the Saudis and the Emiratis, with their engine of prosperity and transformation through technology, try to improve conditions from throughout the region and in Africa. And I think there's a positive story there that should give us hope for the region and its ability to calm a number of conflicts.
When it comes back to the Houthis, though, Norm, do you see sufficient deterrence from the world stage, from the United States?
I see no evidence of deterrence. The Houthis continue to conduct attacks against American military shipping and American shipping. The United States has successfully, with its partners, defended against those attacks, and the United States, with its partners, has successfully degraded considerable elements of Houthis' capacity, but they continue to fire, and the definition of deterrence is that they would stop firing. What we're watching is a policy that did not prioritize deterrence play out.
Norman Rule, always fantastic to get your perspective and insights, sir. The former senior U.S. intelligence official. On that final point, a very important point, a big challenge for the incoming administration to re-establish deterrence once again in the region.
Especially when it comes to Norm's point, the Houthis and the Red Sea, the fact that you still have Western vessels unable to use the Red Sea because they are concerned about Houthi rebels. Also, watch Syria. Norm's point, if Iran loses a stronghold in Syria, what does that mean in terms of Iran being able to support their proxies, whether that's Hamas or Lebanese Hezbollah?
A new front in a fragile region. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Trump's pick for Treasury Secretary Scott Bessent plans to meet this week with key Republicans as he begins preparing for confirmation hearings. Sources say the veteran hedge fund manager will meet with Senate Republican leader John Thune later today. A spokesperson for Trump's transition team says that Bessent also plans to meet with other key Senate Republicans, including the incoming #2 leader John Barrasso, this week. Meta is seeking up to 4 gigawatts of new nuclear energy for its data centers. It's looking for proposals to deliver reactor capacity starting in the early 2030s. The announcement also follows similar ones from Alphabet, Amazon, and Microsoft looking to invest in reactor tech to power their AI offerings. Shares of Eli Lilly moving higher by more than 1% in the early trade. Lilly reporting that its blockbuster weight loss drug Zepbound outperformed rival Novo Nordisk Wegovy in the first head-to-head trial. It was a study sponsored by Lilly where people treated with Zepbound lost an average of 20% of their body weight over 72 weeks. Those who got Wegovy shed 14%. And that's your brief, John.
Hey, Danny, thank you. More from Danny in 30 minutes' time. Up next on the program, setting up for a December cut.
I view the economy as being in a good position after making significant progress in recent years towards our dual mandate of maximum employment and stable prices.
That conversation up next, live from New York. This is Bloomberg TV.
case you missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China show live every weekday.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Two stocks to watch this morning. Here's the first, JetBlue, lifting its outlook. Better bookings, better fees, better stock price reaction. The stock is up by close to 5% in early trading. Turn that story upside down and you've got a good idea of what Foot Locker looks like. Foot Locker down by close to 14%. They've had to cut the outlook. How many times have we heard this kind of language from a CEO in a retail sector? The consumer is being choosy, picky, and smart, trying to find the best deals that they can find.
Yeah, choosy and picky with their products in their particular sector, and that's sort of the question. How much is this a broader macro story? How much is this a marketing play and an execution issue? And that's what a lot of investors are trying to figure out.
We'll speak to an analyst from BTIG in about 25 minutes' time. Don't miss that conversation. That stock getting hammered, now down by close to 16% in early trading. Under surveillance this morning, setting up for a December cut.
I view the economy as being in a good position after making significant progress in recent years towards our dual mandate of maximum employment and stable prices. The labor market remains solid, and inflation appears to be in a sustainable path to our 2% goal.
So here's the latest this morning. Fed officials are leaving the door open to reduce interest rates this month. Zachary Griffiths of Credit Sites expecting Fed funds to finish 2025 in the 425 to 450 range, writing, "We see this playing out in one of two ways. The first path includes a cut in December and a long pause throughout 2025. The second involves the Fed cutting for the next several meetings and eventually reversing course in the second half of 25. Zach joins us now for more. Zach, good morning.
Good morning.
Are you saying hikes if they keep cutting?
We see that as a potential outcome depending on the policy initiatives of the Trump administration, and we're taking them very seriously in terms of tariffs and what they're going to do with migration policy. And so we think that you could have an inflationary impulse from both the labor market and from these tariffs that we think are going to be coming in this incoming administration early on. So we're focused on some of the market negatives in terms of the incoming Trump agenda versus the market positives, which seem to be really holding the day so far.
When we talk about neutral rate, and this is sort of the goal here, is to try to understand what is neither restrictive nor stimulative to an economy that seems like it's just fine. Is this policy restrictive for the investment grade and high yield companies that you cover?
That's the big question, Lisa, that we've been grappling with. And when we look at what you're seeing in the market right now, demand has been very strong. Deals are getting done at extremely tight spreads. And so we've had to reconsider how tight is policy. I think you are seeing some instances in the economy where interest rate sensitive sectors are taking a bit of a hit. But when we think about going forward, I don't think the Fed is in a position to cut as much as the market is priced for if we get this policy mix that we're anticipating. So when we think about What does that mean for investors? We think you have fiscal policy that's going to push yields higher and potentially spreads wider as fundamentals come under pressure, while at the same time you don't have that monetary easing bias that really buoyed markets throughout 2024.
Sorry for a basic question, but some people are arguing that lower rated companies are struggling the most with these high rates, and they're going to have to refinance, and that they're struggling, and that they're not as profitable. And some people could argue that's capitalism, right? That essentially, if you don't have profitability, then you can't borrow as much money, and then you're going to struggle. Why is it actually a problem versus the way that markets were supposed to work after years and years of basically the Fed funneling out free money?
Maybe it isn't, and I think that really comes down to our idea that it's going to be more about credit selection in 2025. So there are going to be some names that are yielding elevated levels that perhaps have a better business model, can get deals done, but you need to avoid the ones that these higher borrowing costs that may be a reality for much longer, they're not going to be around in the next couple of years. You don't want to be owning that debt now.
Didn't we stop playing capitalism 20 years ago?
I mean,
didn't that end?
I mean, that's the issue. So if people thought that, then, you know, essentially the Fed put means that we go back to that. And that's sort of the key question here.
What would constrain the Fed put? And that's inflation. Do you see inflation sticking around to an extent that it would constrain the Fed put?
That's what we're concerned about. And when we look at the near-term path of inflation, we see core PCE stuck around this 2.8% level, perhaps coming down around the middle of the year. And then depending on the policy mix that we get, perhaps accelerating again in the second half of 2025. And that's where you could see rate hikes coming back on the table. I think that would be a pretty big market negative, again, as we've had this backdrop of an expectation of more cuts from global central banks buoying fixed income.
I hate to get really specific about it, but you saying a cut in December, then a cut in March, and they have to think about hiking. How many cuts do you think would be the mistake? 1, 2, 3?
Well, timing it is difficult, and I think when we're talking to our clients, our call right now is you're going to get less in terms of cuts in aggregate in 2025 than what the market is priced for. So that keeps borrowing costs higher for longer. We think that pushes yields higher across the curve, maybe a little bit flatter than what the market is currently priced for. And so when we think about what do you do in that environment, we think up in quality and shorter in duration.
I like how you dodged the question. Zach, thank you. You're out of time too, so I can't follow up. Zach Griffiths there at Credit Sites. Not the first to tee up the prospect of interest rate hikes in 2025.
Because of the potential for this to be an inflationary policy mix, there's a lot of unknown. Despite everyone's euphoria around American exceptionalism, there still is a lot to be determined in terms of sequencing what actually gets through and the muddle that is 2025.
I got coming out of the pandemic wrong because I was so focused on waiting for credit problems and never came around. Sat here waiting for them. Didn't happen.
Well, I think that you can pretty much join all of us because basically everybody got it wrong. So.
I know you were on the same page as me.
I know, we have both got it wrong.
Other people were far more optimistic. Zach, it's good to see you. Thank you, sir. In the next hour on Bloomberg Surveillance, Dan Suzuki of RB Advisors, Janice Stichter of BTIG, Ian Shepardson of Pantheon Macroeconomics, and Ian Lincoln of BMO.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator, invest in that. Think about it, we have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way. People hang on to these great assets. And then how do you get on the same page with the executive team of that company, even if they're existing or new? It requires just amazing communication.
If you go to a cocktail party and somebody comes up to you and says, I have $100,000 I'd like to invest.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Way some of the restraint that we see on the economy toward the neutral path. And that's the reason why you're hearing all this rhetoric saying we're still kind of looking at rate cuts, even if we do get a big number on Friday.
Well, I'm so interested in what Chair Powell has to say today, because when he last had this public appearance, this is before the quiet period, on November 14th, he said the economy is not sending any signals that we need to be in a hurry. What will he say today, given we are so close to the next meeting? Is he going to start to maybe drift back from this idea of we don't need to be in a hurry if everyone else is almost lining up for December?
Chairman Powell, 1:40 Eastern Time, the ADP report at 8:15, so about 12 minutes from now. Coming up this hour, we'll catch up with Dan Suzuki of RB Advisors as the S&P 500 squeezes out a 55 record close. Janice Dichter of BTIG as Foot Locker sees a softer consumer, and Ian Shepherdson of Pantheon Macroeconomics looking for muted November payrolls. We begin this hour with stocks higher, the S&P 500 posting another record high as traders await remarks from Powell and payrolls on Friday. Dan Suzuki of RB Advisors saying the market narrative seems to swing between extreme bullishness and bearishness. Investors should fade both extremes. Even as the narratives have shifted from pessimism to optimism in a matter of months, underlying growth has been quite steady all year long. Dan joins us now for more. Dan, good morning. Are we at an extreme right now that we need to fade?
I think we're getting there. I mean, if you think about it, everybody's getting bullish on the growth outlook, at least in the U.S., and that's why people are a little bit worried about inflation, because growth is so good, and then you're going to have all this fiscal stimulus at our backs. I think people are getting toward extreme optimism.
You've been looking at small caps. Small caps ripped in the month of November, double digits, just like they did in November 2020, just like they did in November 2016. Is that a place you still want to be?
I think so. For the time being, I think it makes sense. I mean, you got to think about the current environment as who's going to benefit most from accelerating nominal growth. And I think that small caps is one of those beneficiaries, among others, and I think that's a great place to be, where you're getting paid to take that position.
So we were looking at some of the earnings, and John made a great point. How do you come up with a bigger story and a bigger thesis from very different earnings pictures, depending on the companies? What do you make of the increasing dispersion that we're seeing between the winners and the losers of this earnings season?
Yeah, I mean, to my perspective is actually the dispersion among winners and losers is actually decreasing. I mean, if you think about it, like a year ago, there was only like a handful of winners, and that was it. And then more and more, every season, every earnings season that we go through, more and more companies are putting up better growth. So you still have those winners and losers, and you're always going to have them. But I would say that there's more winners than losers these days, and the winners are the ones that are geared toward the improving nominal growth environment.
How do you hedge yourself against exuberance that you do see building in markets?
Well, just don't get too far over your skis. I mean, one of the things that we've been pointing out is that people's optimism is getting pretty extreme. I mean, the Conference Board survey is saying that the record number of people think stocks are going to go up. Household equity allocations, people don't seem to realize this. Household equity allocations are at an all-time high, right? So I think the thing is that people have a financial plan for a reason, but people forget the financial plan during times of extreme. So when things are bad, they want to sell everything, and when times are good, they just let it ride. And I think that the whole point of a financial plan is to sort of smooth out those ups and downs.
You have this new report out talking about the $7 trillion on the sidelines, and you say actually, when you look at more nuance, historically, that's not a lot.
Yeah, well, first of all, I think the whole point I put out that piece was just to put shed a little bit more light, because I think there's a lot of headlines and numbers being thrown around with not a lot of understanding. So $7 trillion in money market assets is like getting a lot of headlines, but the reality is that household cash levels are almost triple that amount. Basically $18-19 trillion is the annual revenue of the S&P 500. It's like 3 years of government spending, so it's a big number. But when you put it in perspective of household allocations, it's actually down, because while cash allocations have gone up almost 40% over the last 5 years, stock exposure has gone up over 50% over the last 5 years. And so, the percentage in cash is actually below history and down relative to 5 years ago.
Where do you see a lot of that cash going?
Yeah, so I think that the cash it's not like it's going anywhere, right? It just hasn't kept pace with stock allocations and things like that. But where it is taking share maybe a little bit over the last few years is relative to bonds, because bonds have seen the biggest drawdown in history, almost 50%. And so people don't like it when the things they own go down. They like to own less of it. Cash has done really well. They tend to own more of it. So cash relative to bonds has probably gone up a little bit, but relative to stocks and everything else has actually gone down.
This actually goes to the heart of what you were talking about before, which is when you have a financial plan, it's trying to even out some of the extremes on all sides. Is the way to even it out with cash rather than bonds at a time where inflation could be one of the biggest risks to this entire scenario?
Yeah, I think as you think longer term, I mean, the whole point of a 60-40 sort of stocks bond portfolio is because bonds is the diversifier, but that works extremely well in a falling rate secular environment. If we're right, that's no longer going to be the case going forward. And so the times to own bonds is really that cyclical protection. If you're going into a major slowdown, you want that cyclical diversification. But outside of that, you probably do want less bonds in your portfolio because higher rates is not good for bond prices. So if you look back to like the 60s and 70s, not that we're going into that, but just a higher and rising rate environment, cash actually did extremely well.
At a certain point, are you looking at the risks to this euphoria as being more heavily balanced to a reacceleration or an inflationary type environment rather than that cyclical downturn where bonds would actually provide you some sort of haven?
I think in the near term, that's correct. I mean, I think that you have cyclical and secular forces that are putting upward pressure on inflation. I think right now, that's good for nominal growth. You could get to a point, and you were discussing this earlier, what's the Fed's response going to be to that? And at some point, they may step in to sort of pull the punch bowl away and bring forward that potential cyclical slowdown. So you have to be a little bit nimble here, but I think for the time being, all signs point to stronger nominal growth.
How policy dependent is this call for next year? Is it dependent on the incoming administration doing certain things? Do you have any sort of underlying assumptions?
It's not policy dependent. We don't tend to be event driven. And if you look historically, trying to invest based on policies is the road to ruin, right? I mean, just in this administration, you should have bought, solar and wind, and dirty old energy was the best performing stuff. And you can do that with every administration.
Well, you like energy for next year, which is where this conversation was going.
Yeah, I do. So I think that policy is not the story, but even if you read through the policy, the thing that I like is that it just reinforces some of the cyclical and secular stories that are already in place, right? When I look through tariffs or tax cuts or immigration policy, what I see is pro-inflation. And I think that's already going to be the case regardless of whether you have those policies or not.
Dan, it's good to see you. Always great to catch up. Thank you, buddy. Dan Suzuki there of RB Advisors, talking about that reflation. Yields are higher by 4 basis points on a 10-year. Near the highs of the week so far, 427 on a 10-year at the moment. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. JetBlue shares higher by nearly 4% in the pre-market trade. It boosted forecasts for fourth quarter results. It also posted higher than expected bookings in November and December, as well as lower costs thanks to falling fuel prices. Under its new CEO, JetBlue said that it will pull back to core markets in Northeast and Southeast U.S. and Puerto Rico, hoping to reduce expenses and boost sales after a failed expansion. Meanwhile, on the other side of things, Foot Locker shares plunging more than 15% pre-market. It cut its full-year sales forecast and profit forecast. The footwear chain pointed to an overall pullback in consumer spending and shoppers trading down in favor of discounts ahead of the holiday season. CEO Mary Dillon said the company is focusing on a turnaround plan, renovating a large portion of its stores, prioritizing a rewards program, and revamping digital operations. The matchups are set for the NBA Cup quarterfinals. The first round of knockout games tip off next week. The Knicks host the Atlanta Hawks after beating the Orlando Magic. Orlando will face off against the East #1 seed, the Milwaukee Bucks. In the Western Conference, it'll be Dallas at OKC and Golden State at Houston. And that's your brief, John.
And nobody cares, Danny, and that's important. And I'll tell you why. I know some people care. But TV ratings are down for the NBA, and I wonder if there's a link here between that story and what's happening with Foot Locker, basketball culture at large, whether maybe that's not in vogue right now, and that's why they're struggling.
Or maybe it's because they're all watching the women's basketball teams, because those already took a lot of the oxygen out of the room.
Those TV ratings are up.
Exactly. So
that is true.
I'm just throwing that
it's
out there.
It's an important counterpoint that I'm happy to entertain.
Okay, great.
We can have that conversation in a moment with Janine Stichter of BTIG as Foot Locker reports after consumer spending comes in a little bit softer over at Foot Locker. That stock is down by 16%. Your ADP report drops next.
we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The ADP report is seconds away. Equity futures right now in the S&P just a little bit firmer, up 1/3 after closing yesterday at all-time highs. As we look ahead to the payrolls report this Friday, the median estimate in our survey is 218, looking for a big bounce back from the really soft 12K in the month of October. Looking for the ADP report, the estimate this morning is 150 with the number. Here's Michael McKee. Good morning, Mike.
Good morning. Well, we come in a little bit lower than 150, but pretty darn good estimates today because we get 146,000 jobs found by ADP during the month of November. Now, that is a significantly lower number than the 223 they had found the prior month. And, of course, we only got 12 out of non-farm payrolls. So we'll see what happens when we get the number on Friday. A lot of questions about how much noise is in this data and whether we're going to see a rebound or not. Apparently, we saw something of a rebound in ADP, but not huge.
Mike, a lot of economists have done the work already. The kind of rebound we could expect on Friday, how much of that would come from hurricane disruption? How much of that would come from strikes ending? Are we looking for a number around 100K, Mike? Could it be that higher? Just a snapback for those 2 reasons alone.
Well, we could get around 100,000 in terms of a snapback. The estimate, as you were mentioning, about 200,000. That'll fluctuate this week as these additional details come in. But we had about 30,000 people who were out on strike. They'll be added back in. And the real question is, how many people were out of work the weeks that we saw the hurricane effects in the South, and how many of them have been able to go back to work? That's going to be the real question. And then on top of that, you want to add in what are we seeing in terms of new job creation? The Fed will probably be more interested in that than in the overall number.
Mike, I'm looking right now at the revisions for the prior month for the ADP employment change, and it's about a 50,000 job difference in terms of a decrease from what was reported of 233,000. And I have to wonder, with revisions like this, 50 to 60,000 on a monthly basis, does the surprise have to be really extraordinary, north of 100,000, to really make a difference for some of the macroeconomic calls coming out of the U.S. Central Bank?
Well, it might be. We generally don't see such big revisions in the non-farm payrolls month to month, but because of the fact that so many companies couldn't report due to the hurricanes, there is probably going to be an element of that in these numbers coming out on Friday that we also see in this ADP revised down number, that companies who couldn't report or couldn't get an accurate count for the month of October now are able to report, and we see the revision coming in. Again, the Fed is less concerned with the overall job creation number if it's more or less in line with what we have seen in the trend. They're going to look at the unemployment rate, which is forecast not to be changed at 4.1, but that is not going to be affected. It hasn't been affected by the strikes or the hurricanes.
Michael McKee, thanks for the update, sir. Appreciate it. The ADP report dropping just moments ago. 146, the number, against an estimate of 150. Looking ahead to payrolls Friday, the estimate in our survey around 220. Let's get you some morning calls with equity futures higher by about 1/3%. Your first call is from HSBC, upgrading Merck to buy, noting its current valuation leaves significant margin safety in the stock. That stock is up by 0.4%. Your second call from Morgan Stanley, raising its price target on Salesforce to 405, highlighting excitement around thousands of deals in the pipeline. That stock is up by more than 12%. And finally, Wells Fargo raising its price target on BlackRock to $1,200, citing long-term opportunity following its HPS deal. That stock is up another 0.2%. Let's turn to retail. Soft consumer demand this holiday season weighing on Foot Locker. The retailer slashing its full-year sales guidance and profit guidance. Joining us now, Janine Stichter of BTIG. Janine, welcome to the program. What has gone wrong at Foot Locker?
I think they're actually doing a lot of the right things. This becomes a situation where when you're a retailer that's selling third-party brands, you're only in control of your own destiny to an extent. And we know their biggest brand is Nike. It's less important than it used to be, but it's still 60% of sales, and Nike's been very weak. So I think they're doing all of the right things to differentiate the customer experience, to bring in new brands, but they're fighting an uphill battle when Nike is as weak as it's been. And that's what you're seeing in the gross margin. They've had to promote Nike a lot to get it out the door. And that's where we're seeing numbers fall below where we thought they'd be at this time this year.
And that's why Nike's down at the pre-market as well by roughly 2%. Janine, I'll follow up then. What is going wrong at Nike? What are they not making that consumers want that Foot Locker would like to sell?
Yeah, I think it's really two-pronged. I mean, overall, the issue has been a lack of innovation where for a long time they were really focused on the channel and moving into direct and moving away from wholesale, and they almost kind of forgot about product. And then within that, it's really two categories. Running, where we've seen disruptor brands like On and Hoka make a lot of traction, and Nike's really lost a lot of resonance with that core everyday runner. And then it's on the lifestyle side, and that's what Foot Locker does a lot of, and that's the Air Force Ones, the Dunks, the Jordans, the product that people are wearing for every day to be out in the street and look cool. That product, they haven't come out with anything really new and exciting. And right now what we're seeing is the market is oversaturated with that product, which if you were out on Black Friday, you saw they were taking 30, 40% off those key styles that you would have never seen them discount years ago. In fact, years ago, you would see them selling at a premium on resale sites. So it's really been a changing of the tides where they just don't have that cool product, which is what Foot Locker needs to get the customer in the door.
So basically, Janine, that we can ignore this idea that the consumer is just weaker or not shopping as much. They're just not shopping there because it doesn't seem cool. Is that right?
I think that there's definitely some element of consumer cautiousness, but right now it's just that they don't have the in-demand product because there's not a product that's working for Nike the way that we've seen in years past. I will say that 50% of Foot Locker's consumer is lower income. That definitely is a headwind. And I'll also add that stepping back, I mean, comps were up, gross margins were up, so it wasn't actually a terrible result. I think it was more just that there was optimism built into the back half of this year that you would really start to see a lot of these initiatives coalesce and really get the momentum going. Things like loyalty, better product assortments, store remodels, and all those things are helping, but you still are fighting against the tide of a weak Nike, which really makes it difficult. Last thing I'll point to is we're seeing a big change in the way consumers shop and the cadence of how consumers shop. So we saw a strong back to school season and then a big lull. Now we're seeing a strong Black Friday. We probably will get that lull again going into holiday. So that's made it harder for companies to forecast their businesses, especially when you have one like Foot Locker where consumers are really shopping around those peaks. And then in the lulls, they're just not shopping very much at all. And I think that was a big part of the miss here relative to expectations.
On a broader level, Janine, are we seeing the sort of direct-to-consumer idea fade, or are we seeing that gain traction? As there is a sort of tension that built between the likes of Nike and Foot Locker as they played around with how much they really wanted these distribution channels.
Yeah, I think we're definitely seeing the pendulum swing back in the direction of wholesale versus DTC. If you were to think back a few years ago, it was all about DTC. It's higher margin, you have control of your presentation, you control the customer's data. It seemed like that was the be-all and end-all. I think what companies, particularly Nike is really the poster child of this, what they realized was that they need distribution in other places than Nike.com. Not everyone wants to shop Nike.com. You need Foot Locker to reach a different consumer, and we're seeing them more willing to work with their wholesale partners than we've seen in the past. Nike's the biggest example, but we're seeing that across the industry as well.
Do you feel like they're just putting more money into these items that people don't want? I know Nike and Foot Locker are also having developed a new basketball section called Home Court. They're going to be rolling out in hundreds of these stores in 2026. Is that basically a waste of money at this point?
We actually think basketball has been a bright spot for Nike and for Foot Locker. And if we think of what the Foot Locker of the future looks like, I think that's where they need to invest. Foot Locker is known for basketball. It's what they do best. It's a core competency. So rather than try to be everything to everyone, which is really hard when you're fighting up against companies like Dick's who are putting a lot of investment behind their footwear, do what you do best, invest in basketball. It's what people know you for, and make it a unique in-store experience. Because at the end of the day, when you're selling product that's essentially 80% sold at other places. Most of what you have is not exclusive. You need to differentiate on the customer experience, the selection within the categories you're known for. And for Foot Locker, they're synonymous with basketball. So I actually think that's a good investment for them. It's just not going to pay off immediately. And it's kind of table stakes. This is what they have to do. And we don't know exactly how much that will be able to drive a sales recovery for them.
So do you think it's more things like these almost like experiences you can have in the store that Foot Locker should be leaning into? You started this segment earlier saying that they're really in charge of their own destiny. Is that going to be part of the journey?
I think that's a big part of it. If you think of what makes someone shop at Foot Locker versus going to Dick's or going to Nike.com or on.com, it's the selection that they can curate, but they can't control product. They can control curation. It's the experience in the stores, which is investing in these remodels and home court experiences. And then there's loyalty, which is another big area that they've been investing behind. They relaunched their loyalty program earlier this year. It's something Mary Dillon had a lot of success with at Ulta in driving loyalty higher and getting that consumer coming back. So these are all the things they can do. I think the challenge is that there's a lot they can't do in terms of dictating what Nike does, in terms of dictating consumer health. But they're taking what they can do and putting forth those initiatives.
Janine, appreciate your time. As always, thank you. Janine Stichter there of BTIG with Foot Locker getting absolutely hammered in the pre-market, down by close to 20% now. Ugly. The NBA TV ratings are down, suffering. Shaq says it's because everyone thinks they're Steph Curry. And apparently Steph Curry ruined it. So everyone's just sitting there trying to shoot 3 points that they can't shoot.
Oh, is that so? Is that what he's saying?
Apparently.
Well, I'm not sure. I'm not a basketball expert, and if you actually tried to plumb the depths of my knowledge of either women's or men's basketball, you might be left somewhat disappointed. But I will say that there is a real question of how you keep cool at a time when there is real dispersion around the channels of cool and how they're sort of deployed with influencers.
I remember when Foot Locker used to have NBA players go to the store, sign autographs. There would be lines outside of Foot Lockers, and you just don't see that now.
It's not as cool as it used to be. Can we all agree on that? It's really not.
It's, well, I mean, the 90s, come on.
Yeah, that's like peak cool.
I mean, come on.
It doesn't get any cooler than that.
You had the Knicks, they were amazing.
Let's go back to that.
Yeah, I mean, that was amazing.
They should do a 1990s, like, revival kind of thing.
They will. Wait 5 years.
That's what they should do. Up next on the programme, Ian Shepperson of Pantheon Macroeconomics, Ian Lingen of BMO on this bond market, with yields a little bit higher going into payrolls Friday.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
So we're 60 minutes away from the opening bell. Futures still elevated, still at all-time highs on the S&P 500. We had the ADP report out just moments ago. 146, a really small downside surprise. The number we were looking for, the median estimate in our survey was 150. Some downward revisions as well to the previous month. But all being said, this labour market's looking for a big bounce back on Friday. The estimate we've got in our survey for non-farm payrolls, around 220. Equity futures then elevated up by 0.7 on the Nasdaq 100 with some morning movers. Let's cross back over to Manus Cranny. Hey, Manus.
Jonathan, good morning. Elevated is a very prescient word. Look at the force in Salesforce. This is your classic CRM. We know that, we understand that, but it is their AI product that has a good pipeline. It's called Agent Force. Bit of a difference here. Bloomberg Intelligence say, look, the monetization of the AI product is going to take a few more quarters. Piper Sandler are in there strong and hard. $405, up from $395. A robust multi-cloud adoption. So the revenue and the margins at 33% are strong. Snapshot of Merck. We can debate the political issues for Big Pharma next year, but right now, HSBC popped this up to a buy. It's buy from a hold. They see 28% on the upside, and they say the valuation leaves room to grow. Mary Barra, CEO over at GM, we know her well, pragmatic CEO. She's looking at her China business. The stock was lower. She is going to take a $5 billion hit on the China joint venture between restructuring and the valuation of the equity investment. I like what you said earlier, Jonathan, which was China has its national champions. If not in tech, it is certainly doing that in autos. And this is a moment of reflection. And Mary Barra encapsulates this perfectly. She says domestic brands don't seem to prioritize profitability. They definitely prioritize production. So this is about where can I get better bang for my return on equity from Mary Barra. One snapshot, I'll leave you with this. JP Morgan. This is day 6 on the back foot. I can't see any other flow in this apart from we're down over 2% in the 5 cash trading days. This is day 6 of the downside. It's not some kind of sword of Damocles on JP Morgan, but it is interesting when you go under the hood of what's moving the big bank.
Particularly when that's such a consensus overweight, Manus, going into 2025. The financials, the banks, the likes of JP Morgan. Manus, thanks for that. Mary Barra is one of the best. I love that line. That's absolutely brilliant. They don't seem to care about profitability over in China.
Basically highlighting how they're overproducing in order to flood the world with cheap goods. And they want to support auto manufacturers that just keep cranking out electric vehicles to really solidify their dominance. At a certain point, how much is them throwing the towel in at a time when really foreign companies have a disadvantage?
General Motors, a name to watch this morning. Fed Chair Jay Powell, another name to watch this afternoon, speaking at 1:40 Eastern Time today ahead of Friday's payrolls report. Ian Shepperton of Pantheon, writing low net hiring throughout October, suggests payroll growth slowed primarily due to underlying weakness. We continue to look for a fairly muted 250 rebound in November payrolls, consistent with a 125 trend. Ian joins us now for more. Ian, good morning. Good to see you in person. Now, the obvious follow-up here is hurricane, strike. Yep. Let's clean all of this up. What's the underlying story, and how do you get a clean read on it?
Yeah, well, it's very hard to get a clean read on it, but we do know we got hard data from Florida, so we can strip out the hurricane effect. We know how many people were on strike at Boeing, and we can guess how many other people were kind of roughly affected by it as well. So, we get a reasonable idea of the trend. The catch, of course, is that the first estimate of October, from which we're all trying to estimate the trend, will be revised. And it might be revised enormously because the response rate in October was extremely low, way lower than normal for the month. So everyone is trying to do these very precise estimates based on a number which could just be obliterated on Friday morning. So I think the trend, X all the chaos, is probably around 100 private, 125 headline. So if you're doing roughly 0 in October, you need to do 250 in November just to put you back on the trend. And I think given the incredible uncertainty that we have right now, any more precise forecasting is just, kind of a waste of everyone's time. So I'm very curious to know what the number's going to be, but I'm just as curious to see what they do to October and also to September. Back in the October report, we got a big revision to August. So, we all think these numbers are precise, but they're really not. They're a first stab. And you need to see the second and the third stabs before you've got any real idea.
Elisa has said this repeatedly over the last few months, that the number one number you've been interested in has been the revisions and not the headline print itself. Yeah. And I think we're going to play the same game all over again. Federal Reserve has got to play the game. And ultimately, they've got to take their first stab, and they've got to guess where policy should be. There seems to be a bias to reduce interest rates by 25 basis points this month. There seems to be a belief that they're still a long way away from neutral. Do you believe with both of those?
Yeah, I buy that. I think they will ease by 25. I think they'll skip January and wait and see what the new administration does. But I don't really have any argument with the idea that rates are still meaningfully above neutral. Small businesses, who are half the workforce works for small businesses, they're paying 9.5% for their money, short-term money, if they can get it at all. Credit conditions are pretty tight for these businesses. We all tend to focus, in markets, we're focusing on the large corporate sector, the quoted companies, the S&P. But you've got to peel back and see where most people work, which is not for S&P companies, it's for small businesses across the whole country. And those guys are relying on banks. Banks aren't lending very much, and when they are, they're charging 9.5%. So the Fed needs to get a move on to support that huge mass of small companies, which markets tend to forget about. But that's why payroll growth is now trending, private payroll growth trending at about 100, whereas at the start of the year it was trending at 200. We don't want that trend to keep going down to 0. Now, I'm hopeful that won't happen, but I think the Fed is cognizant of the risk.
I love this. This is the story of the Ians. We have Ian Shepherdson on right now. We're going to have Ian Lingen on later, who actually has sort of an opposite read on some of the same data that you're looking at. And this has been sort of the story where somebody could take a look at data and paint it in two completely different ways while giving a fair shake intellectually to it. I'm thinking about the jolts that we got out yesterday. Some people could take a look at this job openings number and say it's actually better than expected. It actually showed an increase in the number of quits for the first time in 17 months. All of this points to actually job growth, acceleration, positivity. You shed a bunch of cold water and you say, stop it.
Deep breath. Those JOLTS numbers get revised a lot. It wouldn't surprise me at all if that number gets revised down. What actually happens is that the JOLTS job opening number just kind of oscillates around the trend, and the trend is captured much better by the Indeed job postings numbers, and they are just falling, falling, falling. So honestly, initial print for JOLTS, I really don't care. Quits rate gets revised as well. We put far too much faith in these numbers, the month-to-month movements in which are, in many cases, almost random, and the initial estimates are really random. We got to step back and look at the bigger picture.
But is it random that they're all surprising to the upside? And I think that that's the reason why people look at the economic surprise index. There is a clear trend, and that is that people are underestimating consistently where the economic data comes in. So doesn't that give you some confidence?
On the consumer side, that's been the story this year for sure, though I was very interested at the Foot Locker story you just ran a few minutes ago. That was astonishingly terrible. So, it's a mixed picture for sure. The consumer is surprised to the upside, business CapEx is surprised to the downside. And remember, the very last payroll number that we had for October was a big downside surprise. Private payroll is down by 28K, plus or minus 100,000 at least. So, there's no unambiguous story to tell about this economy right now. There are various strands about which you can be reasonably confident. Business CapEx is not doing brilliantly well, partly because the small business sector is so constrained. Manufacturing has probably bottomed out. We've seen a bit of a pickup in global demand for manufacturing, so that's welcome, but it's small. Payroll growth has definitely slowed. Is it still slowing? I'm not sure. And maybe I'll have a better idea after we get the November payrolls and the revisions to the other data. But I'm not seeing any pickup in the leading stuff, like the Indeed job postings, NFIB hiring, small business hiring. That tends to lead payrolls by 3 or 4 months. It's stabilized, but it's weak, and it isn't getting any better. And the consumer, that's really been driving spending, driving GDP growth. They've been relying on drawing down their pandemic savings, which have pretty much gone now. And they've also had a couple of years of very strong income growth, and that's fading away as well. So, last year income growth 4% after tax in real terms. This year, 1 to 2. Next year, kind of the same. So the momentum is not really there. It's not terrible. The Fed doesn't need to be slashing rates in a panic, but the momentum has definitely faded.
So leaving Foot Lockers aside, is this the last hurrah for the consumer? Do you see the consumer slowing down actually next year in 2025?
I do. I mean, I just don't see the sort of growth in retail sales and services consumption that we've seen this year continuing, because the cash flow just isn't there. I mean, most of the time people spend what they've got in terms of cash flow. Over the last couple of years, they've been spending, drawing down some of those pandemic handouts and savings. But that's pretty much gone for most households now. Maybe at the very top, there's still some remaining. And of course, strong stock prices have boosted household wealth for the richest people, but for the median household, cash flow growth has certainly slowed, and retailers, I think, have seen a little bit of this coming. Just looking at some of their pricing behavior over the last couple of months, that seems to me indicative that they're seeing a bit less traffic in the stores, a bit less traffic on their websites, and they're maybe just thinking that we've actually had the best of it. I don't think the holidays will be terrible for retailers, but I don't think it's going to be a blowout holiday season.
Why is this the real deal? After seeing so many head fakes and getting this so wrong over the last few years, why is this time the real deal? What's changed?
Yeah, well, payroll growth is the really big thing. Just, over the last 6 to 9 months, there's been an unambiguous slowdown in payroll growth. And we can argue about the individual numbers. And,
sure.
When Fed officials start quoting individual payroll numbers, I just want to put my head on the desk. But they do it all the time. What they should be recognizing is that the trend has slowed substantially. And you can measure the trend in many different ways as you like, but the fact is that it's now of the order of 100K a month. And this time last year, or even early part of this year, it was of the order of 200K a month, which is not terrible, but it's enough to nudge the unemployment rate up a little bit, make people a bit nervous about future job prospects. We know that it's taking people longer to find jobs if they do get laid off, and we know that wage growth has slowed, which is ultimately what matters.
We're looking for 218 on Friday. I'm just looking at the table of the estimates, and you are near the top, which is unexpected, but you've explained why. You're looking for 250. Do you want to talk about some mid-table mediocrity just to wrap things up?
Oh, did you have to go there?
You knew I was going there. If you don't know where I'm going there, big Newcastle United fan, mid-table mediocrity. What's going wrong?
You've just nailed it, sadly. It's tragic. We beat Arsenal, lose to West Ham, who...
It looked so good under Eddie Howe for a while. Champions League football.
Yeah, it's all, well, a couple of big nasty injuries and also some increasing concerns about a lack of tactical flexibility, shall we say.
Okay, so you're now thinking of a Jose Mourinho come back to the Premier League?
No, anything but that.
It's good to see you, Ian. Thank you, sir. Thank you. Some of the best fans on the planet, Newcastle United fans. Ian Shepperton there of Pantheon Macroeconomics. Bloomberg Economics looking for 182,000 jobs to be added on Friday, coming in below the median in our survey of 218. We're pleased to catch up with Anna Wong of Bloomberg Economics for more. Anna, welcome to the program. Walk us through the underlying weakness that Ian's identified and whether you share a similar view.
Yes, so we identified that the underlying weakness is in leisure and hospitality for the month of November. Now, in October, the weakness that's unrelated to hurricanes or the strike at Boeing was with professional and business services. So these two are rather cyclical sectors, but it's kind of hard to see. I think a lot of people miss these signs because one would have thought that leisure and hospitality would be affected by weather. But what we're seeing is a pervasive, geographically pervasive weakness in leisure and hospitality. And this is the reason why we are not as optimistic as Ian in thinking that it will rebound all the way to 250.
And what's more important, the actual headline number, the revisions, the unemployment rate, or the wage gain?
I think that for markets, definitely the printed non-farm payroll. So it's quite important to know what this Friday's number would be. But in terms of thinking about the real momentum of the labor market, it would be adjusted for revision. So, Powell had mentioned that he pays attention to the QCEW report, and he does this mental adjustment to the printed payrolls. Well, the latest QCEW, which we got a couple weeks ago to no fanfare in the market, is that the average downward revision per month in non-farm payroll should be about 100,000 from July of last year to June of this year. So if you think that everything should be revised down by 100,000 and we're getting 182,000 this month, then the real job creation was only really 82,000, which is well below the pace needed to stabilize unemployment. And for that reason, we expect unemployment rate to climb.
Which is why you're looking for 182 on Friday. Anna, thank you. Anna Wong of Bloomberg Economics looking for 182,000 on Friday. The immediate estimate in our survey, 218. I'm pleased you brought up the jobs report because quits were up, layoffs were down, I know it's the month of October, but it does speak to strength after a conversation lasting about 13 minutes, dominated by weakness.
I mean, look, people feel confident enough to quit, and you actually saw that go up, the rate of people who feel confident enough to quit for the first time going back 17 months. That should be a positive feeling, and yet we just learned why it's all downhill from here and why we're all underestimating some of the potential risks to growth.
Economists are often downbeat, aren't they?
I relate.
Aren't they? The Federal Reserve is feeling confident enough to reduce interest rates, perhaps based on the communication so far. BMO's Ian Lingham with this to say: the incoming Fed rhetoric has been consistent in the messaging that while rate cut decisions are being made on a meeting-by-meeting basis, there is appetite among committee members for another move this month. Ian joins us now for more. Ian, good morning. Good to see you.
Good morning. Thanks
You've
for having me on.
identified this, and I want to go straight to it. Let's not bury the lead. Why's the 2-year at 4.20? Fed's coming out and saying we're all confident we're above neutral. We've got a long way to go. They want to reduce interest rates. Yet we've got this 2-year yield that is just stubbornly above 4%, just sort of stuck there at 4.20. What's that about?
I think that the market at the moment is still trading the results of the election. They're more worried about inflation or a surge of reflation. They're more worried about what happens when there's a renewed trade war. They're not listening to the Fed. They're not worried about the Fed cutting in December, then going again in Q1 and Q2. In a typical environment, one would expect effective Fed funds, which on December 18th will be 4.33, to function as a ceiling for nominal rates when the Fed is cutting. Right now, we could very easily find that uninverted sooner rather than later, which I think would create an interesting dynamic for the market for sure.
So who's right? Is the Fed right or is the market right?
At this moment, I think that the Fed is correct in continuing to normalize rates because they're normalizing rates not because the economy is slowing, not because the jobs market has turned over, but because they believe they have won the war on inflation. And I think that's a nuance that we as a market often overlook. Normalization is not easing, it's just cutting back to neutral.
At the same time, and this really does go to the point that I think the sort of battle of the Ians, I'm going to call that all morning, really goes to, where you can take a look at something like the JOLTS report and say it's either really solid and shows ongoing strength, or you could see that the overall trend is downward. What's the right signal at a time when you hear companies that are talking about reinvesting in their businesses, hiring, after the election uncertainty has been resolved, really leaning into the whole idea of American exceptionalism?
Well, I'm very sympathetic to Ian's argument that we are overdue for a spike in the unemployment rate. The trend has been lower, but the reality is the data continues to show a resilient labor market as a theme. We have an unemployment rate at 4.1%. That's very low by historic standards. The concern, and I think this is shared among a lot of the Ians that I know, is that there's going to be an eventual spike in the unemployment rate that then gets the consumer on the wrong foot.
When it comes to the jobs report on Friday, what number would give the Fed a reason to say we're going to stay on pause?
We need to see a very significant headline print or a 3 handle on the unemployment rate. You give me 350 headline payrolls and a drop in the unemployment rate, then the question becomes, and it's a legitimate question, is neutral in fact higher? Have we not been as restrictive as 550 might have been in prior cycles? I really think it ultimately comes down to whether or not we see a unexpectedly higher CPI number, not payrolls. Because, again, to the point, they're cutting because they believe they've won the war on inflation, not because they're worried about jobs.
Right. So when you look at 2025, and you alluded to this idea that the market is taking the cues from the political economy, the policies that might come out of Washington, what does that mean for the Fed come January?
Well, there are only so many things that Trump can do when he immediately takes office without Congress. So I think that the Fed pauses in January to see what those things are. So they take that meeting off, they reassess the situation, they see the trajectory of growth, they see if the type of tariffs that are announced are the type that they would characterize as a tax on the consumer or would really trigger reflation. I suspect it will be more of a tax on the consumer, a one-off increase in CPI, and then we just move forward.
Ian, do you think that people are underestimating the chance of a slowdown, a material slowdown in the U.S. economy, as everyone talks about incredible profitability and this incredible boom in the stock market and beyond?
I would say that at this moment, people are underestimating the chance that we have a slowdown. What I'm the most concerned about is historically, the Fed has been very successful at taking the edges off of the cycle on the upside and the cycle on the downside. This is what central banks are designed to do. And that has resulted in all of the major corrections occurring as in the form of a crisis. So where are the imbalances? Record high stock prices speaks to this idea that there's a lot of optimism out there and a lot of optimism that's overlooking the potential downside. So a little bit nervous in terms of valuations in the equity space as well as generally in risk assets.
Try and set policy for that, the two-way risk into 2025, both to the upside and to the downside.
Yeah, well, I have to say I'm not a little happy that I don't have to do it. So good luck to all of the people on the committee.
Good luck to Chairman Powell,
exactly.
who speaks later on this afternoon. Ian, thank you. It's good to see you. Thank you, sir. Ian Lingan there of BMO with an update on stories elsewhere this morning. With your Bloomberg brief, let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. President-elect Donald Trump's pick to lead the DEA has withdrawn his name from consideration. Chad Chronister, the sheriff of Florida's Hillsborough County, said that there was unfinished work left in his current role. Chronister had faced backlash from conservatives due to enforcing lockdowns during the pandemic. GM will incur more than $5 billion in charges and write-downs tied to its China business. The car maker expects to write down the value of its JV operations and will take a hit from costs to close factories and restructure its operations in the country. This after years of declines in China and the automaker and its Chinese partner, SAIC Motor Corp. The worst performing airline this year is Tunisia Air, according to Air Help, which ranks based on complaints, arrivals, and departure times and customer feedback. Brussels Airlines taking the top spot for best all around, bumping Qatar Airways to number 2. Two North American airlines made it to the bottom 50, JetBlue and Air Canada. That's your Bloomberg brief. John.
Danny, thank you. Exclusive around the table. Someone who's flown Tunisia Air.
Yeah, it was lovely. Into Tunis.
Oh, so you don't think it's the worst?
No, I don't. Okay. That was fine. The food was good, too.
Good food.
But it was a while ago.
Direct.
Maybe things have changed.
It's running on time. It's win-win.
Oh, boy.
American and JetBlue not doing so well.
Well,
I can speak to that.
You
but
can?
I'll speak to that another time.
Really?
Sure.
Okay.
A little bit later, in a commercial break, where I won't get in trouble. I'm next on a programme, setting you up for the day ahead. You're watching Bloomberg TV.
Is the Vivian Tom clientele? Yeah, power women, like a dragon, dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world. Why do you position your products for this group of women? When I started, designing, I always want to do something that is empower women. When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example. My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s, so it's a more affordable price for them. And then, my powerful woman's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the the only daily business show dedicated to tech, right in the middle of the trading action. Every weekday, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Let's get you a snapshot of some of the price action going into the opening bell in about 36 minutes' time. Equities are higher by 1/3%. Bond yields are higher too. Small downside surprise on ATB. Some negative revisions, but still bond yields up by 5 basis points to about 430 at, let's call it 428. As we count you down to that opening bell, your trading diary, your calendar for the week ahead looks like this. We get some remarks from Fed Chair Jay Powell at 1:30 Eastern Time, followed by the Beige Book at 2 p.m. tomorrow. We'll get the trade balance data, plus another round of jobless claims too. And on Friday, UMich consumer sentiment data and the main event, November payrolls. A sneak peek of next week, Wednesday CPI, Thursday PPI, and an ECB rate decision as well. 25 or 50 seems to be the debate. Just before we go, just a final word around the table. Anne-Marie, I know you've got some reporting regarding the Trump transition and who's in and who's out.
Well, when it comes to defense pick, this idea that Governor DeSantis could get the nod, could be the next defense secretary, actually has legs. And I'm told he was almost basically given the job yesterday. Potentially we'll hear more about this either today or tomorrow, but Pete Hegseth, it looks like a lot of hurdles still stand in the way for him to get confirmed.
My takeaway is that there is so much euphoria in markets around everything going perfectly. There's a real question here about whether we're underpricing a slowdown, and the Ians really laid that out, and I thought that was interesting.
Is that the takeaway from this program? The wrap up from the Ians. Coming up tomorrow, we'll catch up with Max Kettner of HSBC, Nuria Rabini of Rabini Macro Associates, Kathy Jones of Charles Schwab, David Leibovitz of JP Morgan, an Ian-free program. As we head to the commercial break and wrap up this show, we're going to head over to Bloomberg's Michael McKee, sitting down with the St. Louis Fed President Alberto Mussolem at the GIC Central Bankers Symposium. Let's take a listen.
Something that would fall into the category of soft landing or Goldilocks. You know, I try to stay away from labels like Goldilocks or soft landing. You know, I think of it very clinically, and I think, you know, we have a dual mandate, and we have to hit that dual mandate. I don't try to put labels around it. I know folks in the press love to put labels on it, and that's fine. You know, I think as I said when I began the remarks, you know, achieving the dual mandate is within sight. You know, if you look at headline PC inflation, it's 0.3 above target, which is within the margin of error, within the standard deviation. If you look at the labor market, you know, the unemployment rate is at 4.1%. That's below a level, a natural rate. So
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
it might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. Almost like Amazon's or Jeff Bezos' mantra of working backwards. think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do three things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Well, when I was younger, I used to be in bands. I'd play drums in bands and toured America with them, did a lot of session drumming, recorded albums, so yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger, but drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that, we'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the fire line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
On a shooting here in Midtown, New York, the CEO of United Healthcare, Brian Thompson, was fatally shot here in Midtown. We're just getting headlines across the wire, not to be confused with the United Healthcare Group, or United Health Group, I should say, UNH Equity CEO Andrew Whitty, but United Healthcare CEO Brian Thompson has been shot here in Midtown Manhattan, and we'll give you more on that story as we get it. I also want to get over to Michael McKee right now, because he's sitting down upstairs here at 731 Lex with St. Louis Fed President Alberto Musalem and the Bloomberg GIC Monetary Policy Symposium kicking off with the two. Let's listen in.
Forecast between now and the time that resolution of that full uncertainty is is achieved, which could take a year or two. So we're going to gradually absorb information as it is available to us and incorporate new policies into our forecast. Once the contours of those policies are understood and we can quantify things and understand how they would affect the dual mandate.
Well, are you going to say you're data dependent in terms of what the new fiscal policies might be, or are you going to be able to make estimates of what's going to happen and react on those?
So my staff is already making, doing exercises of, for different tariff configurations, how might that affect the economy? For different fiscal configurations, how might that affect the economy? So we're beginning to exercise our muscle memory or forecasting muscle in terms of understanding, so that when you get the final configuration of these policies, we can then go back to all these exercises that we are beginning to do and understand, okay, given what, we have to take those as inputs. So take those policies as inputs and then go and analyze how that could possibly affect our dual mandate goals.
Have any of your scenarios produced positive outcomes for the economy?
The textbook, would tell you that, tariffs would tend to increase the price level and tend to potentially decrease demand, decrease imports, and possibly increase domestic supply. So that's the textbook, that's exercise. We have just been through a large immigration surge, and so we just observed how an economy reacts to a large immigration surge. So you could imagine that if immigration policy were changed, you could observe the opposite, right? Or something goes in the opposite direction, not of the same magnitude, but maybe it goes in the opposite direction. So, and there's a lot of literature and a lot of experience with fiscal multipliers on taxes and on revenues, and so there's a good understanding of that. But that's the framework. But the inputs that we need into that framework are unknown, and we have to take those as given. We can't pass judgment on this. We just have to take them as given. We can't comment on them, and then we incorporate them into our view of the world, and then we will configure monetary policy as needed.
You mentioned we might be getting close to a pause, in part because you want to keep the pressure on inflation from more restrictive policy. Would you also consider a pause to consider fiscal policy, an unknown, an unclear situation, so maybe we better sit back at a meeting or two?
So if you heard my remarks, I didn't mention fiscal policy at all. Right, so my current assessment that the time may be coming when it may be appropriate to consider slowing or pausing is based on how we observe the economy today. And so going forward, you have to observe the economy in the future, and there are a few agents in the economy that are very important. So consumers are very important. Companies who do investment are very important. Net exports are very important, and the government is very important. So if the government is changing its configuration of taxes or revenues, that's going to affect the economy like other sectors of the economy, and at that point, that would be considered.
You mentioned your idea of where neutral is informed by policy rules, and I'm wondering what your sort of monetary policy vision is. Do you rely more on rules or discretion? And you're going to be talking to a lot of people who have opinions about that.
It's a great question. So rules are just a tool to look at and to take some input from. But there are many, many other sources of information that we and I take in to make decisions. So it's about discretion, not about rules. But the rules are helpful because they give you, some reference point to look at. Now, I did not say that the rules suggest policy is at neutral. So those were your words, not my words. What I did say is there's uncertainty about where the neutral rate is. Plausible ranges could be, in nominal terms for the Fed funds rate, could be between 3% and 4%. Seems like a plausible range. Some folks think it's closer to 3%. Some folks think it's closer to 4%. The committee's last SEP in September suggests it's closer to 3% in nominal terms. So depending on where you think the neutral rate is, what policy rules tell you is, given where the economy is, on top of where the neutral rate is, where should the policy rate be today? And that's why today the policy rate is above its neutral rate, because inflation is still above 2%.
Well, it sounds like you're more concerned about inflation than you are about recession at this point, and you are looking at a policy rate staying above neutral for perhaps longer than some people, some other your colleagues or other people anticipate?
What I will say is, when I observe my colleagues, I'm certainly very committed to bringing inflation back down to 2%, and I know my colleagues are also very committed to getting the job done. So I would not say that I'm more committed than my colleagues, if that's what you're trying to imply. I think we're all equally committed to bringing inflation back down to 2%. You know, at present, it seems to me like inflation has been higher than I would have liked, and I think that some of my colleagues would have liked. And the concern about the labor market that was there during the summer has ebbed. And so right now we have, at least the way I see it, is less concern about the labor market having a disorderly adjustment. And to my eye, the risk that inflation stays closer to 3% than coming down to 2% seems to have risen. Not because of the future, but because of how I see the economy today.
We'll get a little more wonky here. We do appear, as you suggested, maybe is happening, that we might be stalling out a little above 2%. What has slowed progress at this point?
So, as I said in my remarks, if you get inside the inflation indices, we've seen a lot of progress on goods inflation, core goods and non-core goods. We've seen a lot of progress on energy inflation, which indirectly feeds into core, not directly, but indirectly through the production process. We've seen some progress on some services, but when you look at services in their totality, they're still running high and higher than they did, pre-pandemic. And housing services inflation has been sticky, but that is always very lagged. As, you know the data very well, and that takes between the time that market rents for new leases began to decline and the time that housing services inflation, as they're measured in the indices, actually declines. It could be a period of 2 years. So the good news is that housing rents for new leases are declining, and that would suggest that overall housing inflation should decline over time.
Well, as you look at inflation, if you take housing out, you're pretty much there at 2%. Some people think you will go below it on a PCE basis. So are you looking through housing now as you consider where the economy is and how restrictive you are?
I prefer not to be selective when I look at the different inflation indices. So I include housing in my understanding of indices.
What about the data itself? We saw JOLTS come out yesterday. A lot of your colleagues have suggested maybe they're giving us a misleading impression because the response rate, in part, is so low. Response rates for all surveys have gone down. How much confidence do you have that you're getting a true picture of the economy? And I asked that with essentially the forecast ahead for jobs on Friday. We've had some significant revisions to the jobs reports. Are you concerned that you have accurate enough information to feel confident in whatever decisions you make?
This is a great question, Mike. So there's always there's a lot of people in the room here that are observers of data and former policymakers, and it's just something you have to live with. Is the data is uncertain. I once had a finance minister from a country that's dear to my heart tell me, Alberto, you got to understand that in most places the future is uncertain. In our country, the past is uncertain. So, meaning you have to live with data revisions. You have to live with what you thought was true at the time may turn out to be revised after the fact. And we understand that. We understand that, when you see a number, you take it as is, but you can't be 100% sure that that is the final number. So that's just a fact of life. You have to live with it. You are correct that a lot of the data we looked at, particularly in the labor market side, the response rates have been declining. Also, there's an issue of, the very important immigration surge that has happened, has led to divergence between the establishment survey and the household survey of the labor market, and that's, a little harder to reconcile nowadays than it was previously. So, I take every data and mentally I understand that there's a confidence interval I need to put around that data. I don't take it as, a true point estimate. I understand there's some uncertainty.
Do you think that because you have to put out an SEP under those circumstances, and of course now with December...
All right, that was Bloomberg's Mike McKee speaking with St. Louis Fed President Alberto Musalem. You can continue to follow that conversation by typing LiveGo into your Bloomberg terminal. But we do want to go back to that news that broke right before we went on to air, and that is that United Healthcare CEO Brian Thompson was fatally shot outside of the New York Hilton Midtown in Manhattan this morning. United Healthcare is United Health Group's insurance division, and we don't know very much so far, you guys, but the New York Police Department is saying that, again, Brian Thompson, he is the CEO of United Health's insurance division, was fatally shot just this morning.
Yeah, outside of his investor day, and obviously that investor day has now been canceled. I think it is an important distinction to make that this was the insurance division of United Health Group, so it wasn't Andrew Whitty. Obviously, it's horrible news no matter who it is, especially the idea that it was here in Midtown Manhattan is absolutely chilling ahead of his investor day. Brian Thompson was the CEO of United Health Care, the insurance division of United Health Group.
And not surprisingly, United Health has halted the Investor Day event. Remember, this is a very dense area in Manhattan, in Midtown Manhattan. To your point, we don't know, Katie, a lot of information yet, including about the shooter and the motive behind what had happened, but certainly very sad.
So we will continue to follow this story and bring you more details as we have them. And meanwhile, we are about 15 minutes away from the market open. You can see right now that futures are higher on the S&P 500, up by about 0.4%. Big tech, one better. The NASDAQ 100 up about 0.8%. The small caps, too, seeing green before the bells ring. Now, coming up, we'll speak to Jack Janasowicz. He is portfolio manager and lead portfolio strategist at Natixis Investment Managers. This is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound.
Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Let's get out of high interest. Look at what's making headlines around the world. Back to the news that broke right as we went on air today. United Healthcare CEO Brian Thompson was fatally shot outside the New York Hilton in Midtown Manhattan this morning. United Healthcare is United Health Group's insurance division. Thompson was shot outside the New York Hilton, where the company was hosting an investor day, and that investor day, I think, obviously has now been paused, if not completely canceled. We'll bring you more details on that story as we get them. In France, the President Emmanuel Macron is asking lawmakers to reject a no-confidence vote that would topple the government. Far-right leader Marine Le Pen and her National Rally Party have vowed to support the motion submitted by a left-wing coalition. Lawmakers debate and vote on the motion in less than an hour from now. We don't know how long the vote will take, but we'll bring you those results as soon as we get them as well. Here in the U.S., President-elect Donald Trump is reportedly considering Florida Governor Ron DeSantis as a possible replacement for Pete Hegseth to run the Pentagon. Trump allies are said to wonder whether Hegseth will survive further scrutiny of his personal life after allegations of rape and an alleged 2018 email from his mom accusing him of a pattern of abuse towards women. And Shonali, there's a lot going on. We're going to keep you apprised of all these stories as we get news across the wire.
Absolutely. For now, we turn back to the markets. Joining us now to talk about it, Jack Janasiewicz, portfolio manager and lead portfolio strategist at Natixis Investment Managers. You know, in just a couple days, we will be exactly one month from those election results. And my question becomes then, and by the way, that's the same day we get the jobs report as well. So do you switch gears? Do you make this about the politics, or do you make the way you're thinking about your next investment about the macro?
I think you start out by thinking the macro, because at this point, you still have quite a few tailwinds, right? And I think the big one is simply, listen, the Fed is actually in easing mode. We can argue about how many rate cuts we'll be getting between now and the end of 2025, but you know, you're still getting an easy Fed, and the economy's still holding up fine, the jobs market's still holding up fine. That's the underlying theme. Switching gears and talking about the Trump policies, if you will, you need more details on that, and that's going to take some time for it to work its way through the system. So it's sort of maybe in steps. I think the base case is the fundamental story, and then as we start to get more details on policy, we shift accordingly.
So let's build on that, this idea of an easy Fed, because we actually just heard from St. Louis Fed President Alberto Musalem saying that the time may be near to slow or pause rate cuts. And I wonder just how much optimism is baked in that we are just at the start of an easing cycle.
Yeah, and I think counter that with comments that we had from Williams and Mary Daly, from that and Waller actually as well. They're both, all three of them are somewhat hinting at potential cut for this December meeting. But I think the market's already sort of pricing in maybe in every other going forward and looking at an incremental 2 or 3 for the rest of next year, which I think is probably right. I think from this perspective, though, rates are still restrictive. There's room for them to ease at the margin. Maybe don't have to go 5 or 6 times, but we're still at a restrictive level, and I think that is the underlying narrative here.
But how much further can we go? I mean, the market's pricing in, I think, a 4% terminal rate, and the dot plot, at least the last one we got, is for 3%. So that's a pretty big dispersion.
Yeah, and I wouldn't be shocked when we get that new SEP out, you're going to see some of those dots drift higher. So, I think the market's probably right smack dab where they should be right now in terms of expecting rate cuts going forward. And then it's going to go back to data dependency. If things start to slow, I think that Powell put kicks back in, and you're going to see the potential for maybe more pricing of rate cuts going forward. But if the data remains firm, we probably still stay on this holding pattern here.
What does it mean for the mix of stocks and bonds in your portfolio? Because it's interesting, the 10-year, we've been watching it so closely. Yesterday, we watched Katie point out less than 420 on the 10-year. You're now back to 426. The volatility is incredible. And if you believe you're heading lower, then do you buy more? Because you think that maybe, you know, the S&P valuations topped out, room to run the bond market.
Yeah, but I think from a bond market perspective, you're probably going to be earning your yield, and maybe you get marginal appreciation with regard to maybe a tighter level on spread, but for the most part, I think we're range bound, and you should be expecting to basically earn your carry in the fixed income market, plain and simple.
That's interesting. And when you talk about the fixed income market, are we talking about treasuries, or are you looking towards corporate credit here?
So you need to put this in the context of a traditional 60-40 portfolio, right? And I still think we have a bullish outlook for equities going forward, so I'd rather spend some of that risk budget on the equity side of the equation. So, you know, with corporate spreads as tight as they are, maybe not a ton of room for spread compression. But the flip side to that is I might move a little bit away from that, own treasuries, because I want to take more risk on the equity side, and I want some of that equity risk offset, and I need that through the treasury side of the equation.
What are the warning signs that you look for, Jack, in a frothy market? Because, you know, over the last 6 years, total return is more than triple on the S&P, right? And we're looking at record tights here. We keep getting reports that U.S. households, as well as institutions and international, are all, you know, more equitied up than they've ever been before. And we don't see a ton of leverage in the system, but what do we look for?
You know, and I think part of that is really more of an art than a science, so to speak. And I know we spend a lot of time focusing on risk appetite, and there's all sorts of metrics that we pay attention to, whether it be sentiment surveys, flow data, you know, and just conversations with our clients. And I would say right now, you know, what would make us more concerned about that risk appetite backdrop would be clients asking us what else should they be buying. We're not getting those kind of questions right now. We're still seeing people piling into fixed income, you know, short-term treasury bills, money market funds, because they're still getting a pretty decent yield. And so from that perspective, I don't think we're at that stretch point where I'd be a little bit concerned where risk appetite has run so far that maybe it's time to start pulling in the reins a bit.
What's the case for just looking at the macro? Because you see these individual corporate stories, and you see a ton of retailers really muddling through this environment. There are many citing a weaker consumer just this morning. Yep. Look at the hit Foot Locker's taking. And so when you see those types of numbers come out, do you consider it dispersion, or do you consider it a sign of trouble?
You know, I think this is the case that's been going on for quite some time now. It's the bifurcated consumer, right? You've seen sort of the middle and upper echelon income cohorts still doing quite well. The bottom cohort's really getting squeezed. And the one thing we remind our clients here is simply, you know, that lower income cohort doesn't account for a ton of that total consumption out there. You know, if you look at sort of that maybe the 20 percentile or lower, it counts for less than 10% of total personal consumption expenditures. And what's the big driver for the U.S. economy? Consumption. So when you have 80% of the consumers still in pretty good shape, it's tough to really get too concerned about this right now.
All right, well, that's a good place to leave it. Jack, it's great to see you again. That is Janice Seawitz of Natistics. Meanwhile, let's get a check on these futures right now. Just minutes away from the opening bell, you can see we have a rally on our hands. The S&P 500 up 0.3%. Big tech leading the charge right now, and the small caps also rallying as well. Your Russell 2000 up about 0.2%. We'll discuss all of the market moves at the opening bell with Sarah Hunt. She is Alpine Saxon Wood's chief market strategist. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
All right, after 55 records on the S&P 500, we're set up for yet another one, and this year could now eclipse 2021 as the best year in 6. We're looking at more than 26.8% gains on the benchmark index. You can see futures are up 0.3%. NASDAQ futures are up double that right now, and Russell 2000 futures are trailing. In terms of the opening bell, you hear it down in the New York Stock Exchange Ally ringing the bell there, and at the NASDAQ market site, you've got GoFundMe. Apparently, there's like a Giving Tuesday thing, which was yesterday, and it's raised billions of dollars for charity. I'm finding out about all these new special days that we have, Katie. What I do know is it was a record day for the stock exchange, and we're looking at possibly another one today. What do you see in terms of the major averages?
At least where it stands right now, we would close at a record high. We are above 6,000 and then some on the S&P 500, currently higher by about 0.3%, just 35 seconds into trading. But it's big tech that's leading the way right now. The NASDAQ 100 up about 0.7%. The small caps underperforming a little bit today. We know that that has been the outperformer. It'll be interesting, of course, to see the reaction to Jerome Powell coming up this afternoon ahead of Friday's jobs report. But this is where we stand as of this moment. Let's look under the hood right now and talk about Eli Lilly, higher right now after its weight loss drug Zepbound outperformed Novo Nordisk's Wegovy in a head-to-head trial. We'll speak with Eli Lilly's chief scientific officer in the next hour, and at least right now, shares up about 1%, Chinali.
I'm watching Salesforce here, Katie, because you're seeing it soar about 10% this morning. It is pairing gains. It was up more. Results beat estimates and raised hopes about the company's AI strategy. The share is still up more than 9% as the market opens.
All right, we're watching, obviously, Salesforce and the push that gives to the NASDAQ, but I'm watching General Motors getting a $5 billion hit from charges, write-downs due to its struggling operations in China. Had valued the business at $6.5 billion, and now substantially less. Let's take a closer look at some of the companies reporting results this morning. For that, we go over to Bloomberg's Abigail Doolittle. Abby, what do you see?
Yeah, Matt, let's take a look at a couple of the retailers. Really a tale of two stories here, two retailers. Dollar Tree up about 3.1% off the pre-market highs, but nonetheless, they beat and boosted. Foot Locker, on the other hand, you can see plunging down 18.4. They missed and cut the view. So let's dig in a little bit deeper to what investors like and don't like. Relative to Dollar Tree, this company's really been having a tough time this year. You can see all of these not so great negative comp sales where they've missed, but here we have up 1.8% in the quarter that was. Again, they beat on both the top and the bottom line. In addition, they've also boosted the view. This stock down into today about 49% on the year, 6% bear short interest. So that's why we have the bullish reaction. Expectations were low and they beat. As for Foot Locker, on the other hand, there's also a bear short interest on this stock. The stock down less on the year, down 22%. But relative to the guide, while this looks positive because they're coming out of negative territory for comp sales, the 2025 overall estimate is lower than what they had been looking at, up 1 to 3%, and the street estimate of up 1.64%. And it seems as though the holiday is really hurting a little bit. And from a feet on the street perspective, Katie, I was out shopping yesterday in Westchester, and I can confirm I was really one of the only people out in a couple different stores. And I was thinking to myself, is this the holiday season? It seems as though Foot Locker's maybe seeing something similar with the outlook that they're providing.
Yeah, some good on-the-ground reporting there.
Yeah, Westchester's so big. Where were you, Abigail?
Well, to be specific, I was in Scarsdale at Saks Fifth Off Avenue, empty. It's a massive store. I was also in Fox's, empty. Barnes & Noble. Actually, there's a little action in Barnes & Noble, so books. That's what people want this holiday.
People want books, the gift of knowledge.
Prove their minds.
Yeah.
If you got a book in you, you need to get it out, you know?
That's true.
If you have a novel in there somewhere, Katie.
Yeah, you know, you just got to write it down. Abigail Doolittle, thank you so much. Let's broaden out this conversation now with Sarah Hunt. She is Alpine Saxon Woods Chief Market Strategist, joining us on set. Great to see you in person, Sarah.
Good to be here.
So I am stuck on this comment from Alberto Musalem. Of course, he is the St. Louis Fed president, speaking earlier today, talking about it may be the time, or the time may be near, rather, to slow or to pause rate cuts. And the reason he gave was that we have higher than desired inflation. And we haven't heard a lot of Fed speakers acknowledge that it seems like we've stalled out when it comes to progress with inflation. Going into 2025, how big of a risk is it, the potential for a re-acceleration of inflation?
I think that is going to show up in a lot of year forward strategy outlooks, because I think that there are obviously some forces that could be inflationary. The question is, how much do we get of the tariffs that might come in? How much do we get of immigration reform? How much of the things that people are worried about that could do that? And then what else can come up? I mean, the South Korea situation, I think, took everybody by surprise. So there's obviously things on the global stage that can come up. And so I think that one of the things that people are going to be looking at is, are we really seeing a kind of quiet inflation, or is there some coming back of that? Because that will really, I think, spook markets as well as potentially the Fed.
But if you do see inflation, I mean, stocks are a great thing to own in that situation, right? Especially if you have deregulation, lower taxes, and we're light on tariffs and deportations, right?
You can see a lot of different scenarios, which is why I think it's going to be interesting to see what everybody's look ahead is for 2025. Because from our perspective, the probability scenarios are that there's a lot of different places we could go. And I think that it could be good for stocks, but there's also rates coming down are good, right? So if that looks like that tension is going to change, then higher rates may be more problematic. And that might be difficult given that where valuations are. If we were starting at low valuations, it wouldn't really be an issue. But we're starting from valuations that are just making daily highest records. So I think that's some of the tension that we're going to have going into 2025.
You know, I think I'm in the group a little bit of the worry ward here, because you're sitting here near record highs in the stock market, but you see signs of the consumer cracking in certain areas, and that higher inflation or not reasonable inflation is still being cited by a lot of executives as one reason why. At what point does that spill over?
It starts to spill over when earnings start to be affected in a really negative way. And right now you're looking at things like one-offs. And people look at Foot Locker and they'll look at individual stories and they'll say, there's a reason that this story is having a problem, and I can't extrapolate it to the entire situation. Now, the fact that Dollar Tree had good numbers when some of the lower-end consumer has been really struggling, I think that a little bit of a turn, that gives people confidence that it's all idiosyncratic as opposed to problematic on a larger scale. But there's definitely a bifurcation on the earnings side, and where that spending goes has obviously been bifurcated for some time, and that's not really changing.
And by the way, Dollar Tree, the chart looks very bad. I mean,
Foot Locker is just as bad now almost. It's down 35% this year, more.
Dollar Tree is down 50% year to date, and, you know, it's not been good over the last 5 years.
Yeah, it feels like there's a lot of have and have-nots when it comes to the retail, the apparel categories. And how do you approach that from a portfolio construction sort of perspective here? I mean, do you play in that space, or do you try to avoid some of those sectors that are more oriented geared towards the consumer?
Well, I think that since for the last couple of years, you've seen the lower end consumer have a harder and harder time, and inflation certainly made that worse. So you try to stay away from places where the main customer is your lower end consumer, either on the credit side or on the retail side or wherever you're looking. But you've also noticed that in some cases you have a land of different worlds for some of the very luxury retail stuff, because you've had more trouble in Gucci and better stories for LVMH. It is not a clear picture, so what you're trying to go for is areas where you see that there is some continuity of growth that ends up being a lot of technology on the retail side, but it's also, you can see that some brands have got a situation where they're better off than they were, but even some of that has backed off from the highs.
Is there a stock that you love that you get up in the morning and you're like, yes, I'm going to talk about this on Bloomberg? Or is there one that you tell people at, cocktail parties, stay away from that stock?
Well, what's interesting is you've seen a re-rating in the pipe stocks. The pipeline stocks. I was actually away for a couple of weeks, so I wasn't watching every day, which is an unusual situation.
Good for you.
I know, it was great. But I came back and I looked at all the pipeline stocks and I was like, wow, all these stocks have had a little bit of a re-rating after being essentially dead in the water for quite some time. And I think people are looking at energy infrastructure, and they're looking at infrastructure. You saw natural gas prices start to soar in Europe when you start to see some of the deliverability issues and some of the weather issues. And I think that there is a deeper understanding that the energy infrastructure has a value and is going to continue to have a value regardless of how we try to change our carbon chain.
Speaking of stocks that people love right now, I'm taking a look at Marvell Technologies, of course. Very, very promising outlook that they've given investors, to the point that you now have the stock at a new record high. It's up another, it looks like 19% right now. I've just kind of been watching it on my screen. You also have Salesforce up very meaningfully today. What does this say to you about the AI trade?
It continues, right? There was a period of time where people thought, well, maybe this is more hype than reality, and maybe this is something that we really have to start to see come through the numbers. It's coming through the numbers. That is something that is going to help keep this market in good shape, because the big question was, we have this fantastic story, and you can spin a great tale on it, but if I'm not making more money, or if it's not making me more productive, or in the end, if the promise isn't actually coming through to numbers, then it's not going to continue to hold the market higher. The fact that you're starting to see this come through is showing you that, and I think Salesforce was punished pretty badly at one point for not having an AI story. So the fact that they can turn that around and have one now tells you that this is still a big driver for the markets.
All right, Sarah, got to leave it there. Really appreciate you coming into studio and taking the time. That is Sarah Hunt of Alpine Saxon Woods. This is Bloomberg.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together, and that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice and my conversation, my poetry, you know.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything. From the world of politics to the world of business, Joe Matthew and Keely Lyons deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Welcome back to Bloomberg Open Interest. A quick check on stocks about 13 minutes into the session. You can see the S&P 500 climbing right now, up about 0.3%. Big tech is your leader with the NASDAQ 100 up about 0.6%. And momentum building behind the small caps just in the last couple of minutes. Now up 0.4% on the Russell 2000. We'll continue to keep an eye on the big benchmarks. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, HSBC is upgrading Merck to a buy. The analyst says that current valuation leaves a significant margin of safety in the stock. Next up, we have JP Morgan downgrading M&T Bank, saying it's no longer a buy, and also saying that the bank's commercial real estate exposure will remain a headwind and doesn't see any catalyst for continued outperformance. And finally, the sell ratings on Maersk are stacking up. Now, Morgan Stanley giving the global shipper its 10th sell equivalent rating today. The analyst says that negative earnings risk make Maersk a, quote, value trap, and adds that he sees container supply growth outpacing demand, Matt.
All right, let's get back to the news that broke right as we came on air today. United Healthcare CEO Brian Thompson was fatally shot outside the New York Hilton Hotel in Midtown Manhattan this morning. United Healthcare is United Health Group's insurance division. So UNH, their insurance division, the CEO of that unit, not the CEO of United Health, Andrew Whitty. Nonetheless, it's a tragic story. A man who was just about 50 years old. Bloomberg's Katya Porzakansky is here with us, our bureau chief, New York bureau chief. So what do we know, Katya, so far?
So the story is still unfolding, but we have from police sources that the individual, the suspect who has still not been caught, may have been waiting for Brian, who was coming in early to deliver an investor presentation. He was coming in early, I think, to maybe work on it or something. He was there at 7 o'clock in the morning. The individual seemed to have been waiting for him, shot him in the chest from about 20 feet away, and then ran off through the Ziegfeld pass-through, which, I mean, if for those familiar with New York, with Midtown New York, of the New York Hilton, the Hilton, which is right near the Times Square area, and then the Ziegfeld Ballroom close by. There's a pass-through between the buildings, and so the police are looking for him right now. We expect that we'll have a press conference from either Mayor Adams or the police department soon.
This area in New York is a really dense area, as we had been talking about. It is flat dab in the center of Midtown. It also happened during the company's investor day, as we've been talking about. Executives had continued presentations until 9-10 a.m. pretty recently. What do we know about the area right now and how the company is handling this?
Right now, we haven't heard much from the company other than that they have ended the investor day. We have sent 2 reporters to the scene, and I'm sure we'll have some color from them shortly. We're very curious to see who was there, who saw what, and I'm sure a lot of rattled people. But because it does feel, at least at this stage in the investigation, it feels like a targeted shooting as opposed to random shooting. As grim as that is, it tends to be calming to masses, right? So that it doesn't feel like this is a random shooter that is going around shooting people in Midtown.
Well, Katya, we'll look to you and your team for more updates throughout the day. Like you said, reporters on their way to the scene right now. That is Bloomberg's Katya Porzakansky, and we'll bring you all the latest headlines as we get them. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back to Bloomberg Open Interest. You take a look at stocks right now. We have a rally on our hands right now. If we closed right now, this would be yet another record high for the S&P 500, up by about 0.3%. Your biggest points contributor to the upside is Microsoft, and followed by Amazon. And you can see that reflected in the NASDAQ 100, which is higher by about 0.7%. But keep an eye on the small caps. That rally is building. Of course, we were pretty much unchanged at the open, but just about 20 minutes into the session, the Russell 2000 now higher by about 0.5%, Shanali.
And Katie, it's time now for the Wall Street Beat. Today, we're looking at a Citigroup decision to dismantle its Asia high-touch equity sales trading desk 5 years ago. For more, we are joined by Bloomberg's Sridhar Natarajan. Walk us through exactly what has happened at this trading desk and what it means for their larger strategy to move past regulatory hurdles to really boost this trading desk.
Well, so let's zoom out a little bit and even look at why we care about the Citi equities business and why there is so much focus on it and there is so much angst out there. Citigroup, the company, the stock is up 40% this year, which sounds good, but it is still the worst performing big bank in the United States. When you look at their equities business, there has been a lot of focus there, not just with regards to misbehavior in terms of trades, but also culture questions, harassment allegations, and a lot of other such things that have really put the spotlight on this business. Last year, they made about $4 billion. This year, they're on a track to do a little bit better, but still would likely end up about $2.5 billion behind Bank of America and a country mile behind the top three. So there is clearly a lot of pressure there. This Asia story in particular focuses on what happened when the regulators came in and put down the hammer. They were looking at how the bank's traders were carrying out, trying to drum up business, trying to tell clients that there is indication of interest, that they should sell their stock to them. They will find a market for that. It wasn't always genuine. That clearly is inappropriate behavior, but the traders would tell you that was the culture out there. There was pressure to bring in more revenue. There was a focus on the biggest stocks in Hong Kong and elsewhere in the region, and they had to resort to behavior like that, which then takes us to the bigger question. When things like this happen, when we find misconduct, who is to blame? Is it the line trader, or is the management culture at fault here? And that's something that banks, all big institutions, have always wrestled with. And at least in popular perception, the cynical view has been management always goes scot-free. It's the line trader, it's the pawn that gets dismantled.
Of course. That's how it always happens. Sri, what about on global Wall Street, when you're a trader, a successful trader, maybe at a different bank, do you want to go to Citi? Is that a place that they want to go? Like, do headhunters bring people there, or would they rather go to other places?
Depends on your attitude. Do you run into a burning building or not? Because clearly there is trouble there. Clearly they've fallen behind their biggest competitors and their rivals, but it also means that you're buying low and have the option to sell high. So you could go in there and turn around the business. So if you're a management leader, that option exists. There's no indication, to be clear, that Jane Fraser is saying we need to dismantle the existing Citi Equities leadership, but I'm sure they're certainly feeling the pressure that they need to improve the business and get beyond some of these uncomfortable headlines that have been focused on this equity.
And dispel the image of, like, we throw our traders under the bus when bad things happen.
Dispel the image that nothing is working in that business right now, and it's not just an equities problem. And across the Citi operational structure, there seem to be a lot of issues, and that's why Jane Fraser, who's about to enter year 4 as CEO, is facing the heat.
Well, let's talk about an unrelated but another uncomfortable headline. This from a Bloomberg News story that Citi faces $26 million in losses on an Australian block trade. What do we know about what went wrong?
Look, when you're running a risk business, anytime you're standing in between sellers and buyers of stock, there will always be some risk. The question is, how well do you manage it every day and through the quarter and through the year? If you look at someone like Goldman Sachs, one of the best performing equity trading houses, it's not like they don't have down days. In fact, Goldman Sachs on occasions during the quarter will have days when they've lost more than $50 million, but they more than compensate for it with up days, which are significantly higher and significantly more voluminous. For someone like Citigroup, it's not really helpful to have headlines like this. It's not really helpful to lose a business like this. And this one's interesting. It's a block trade. They underwrote it at a very tight discount. Clearly, the market did not want to buy it at that level because you're bringing a big slug of stock into the market. They want a bigger discount because the stock is going to go down after the trade is reported. Then they tried to rewrite the deal, gave a wider discount, but by that point, the market's already been spooked. The little slug that they did manage to sell off was below the level where they underwrote it, so they've clearly taken a hit there. They're still stuck with about $1 billion Aussie dollars of stock on that. That could go bad for them, but if the stock were to rebound, they could make up for these losses. But it's not a good image for someone in the business of trying to sell blocks that you don't have a correct sense and grip on where to price the deal.
All right, Citigroup, our focus, and it's just a deep underperformer. Over the past 5 years, the stock is still underwater. It's down today. Shri, thanks so much for talking to us about Citi. General Motors, another stock that's off today after writing down its China business. It's going to take a $5 billion write-down. Some of that money is going to be to close factories. Some of that money is going to be for the reorganization and some to reduce the value of the equity in joint venture with SAIC in China. This is, I think, a very interesting story because they have been successful in this business in years past, and they do have brands like Buick that are popular in China. They do have models like the Cadillac CT5 that sell well in China, but there's so much uncertainty, right? With Trump coming into office, with Xi maybe reacting against even higher tariffs, who knows what the future looks like for American companies doing business in the world's largest car market?
Yeah, it's a huge question mark, and it's interesting that they're not walking away. We've seen plenty of automakers close or sell plants and also walk away from similar joint ventures. This is framed as sort of a revamp, so they're still trying. They're still trying to get back to that profitability. It's interesting to see the share reaction. We were down much more significantly on GM, but coming back a bit.
Yeah, that's pretty fascinating to see. Maybe this is not so bad. The interesting thing is, even though you have this initial hit, it doesn't think they need additional capital in a venture that they still want to keep going. But to the point that you're making, if China invests in its own automakers, what place does that make for American automakers that want to pair up and do business there?
Yeah, it's a very good point. There's just too much uncertainty, I think, going forward to keep this business valued at $6.5 billion. So they cut it down significantly, but they still think they can make a profit there. They still think they can turn that business around. We are going to continue talking about car makers. In the next hour, we have the CEO of Lamborghini, the Italian supercar unit of Volkswagen. Stay with us for that. This is Bloomberg.
I am the owner of the family office and the company called Company I Limited. I also have a live streaming channel for startups. It's SG Trader, so we let startups to pitch investment community on our channel. I give them 3-minute pitch. We publish their video on our channel, and everybody who is interested, please welcome to send me your video, and I will roll for almost a month your video for all financial community. The channel is live, it's streaming live 5 days a week, from morning till night.
Another thing that startups need to look for,
is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez in New York, where a top healthcare executive was shot and killed this morning. Police say it was a targeted attack. Odyssey New York's Marla Diamond is at the scene.
This is 50-year-old Brian Thompson, the CEO of United Health Group's insurance division. They are holding an investor day here at the Midtown Hilton. Thompson was shot once in the chest and rushed to Mount Sinai West in critical condition. Doctors there were not able to save him.
Police are searching for a man wearing a black face mask. They say they do not believe there's any threat to the public. They also say they do not know the motive. The Supreme Court is taking up the case of transgender kids under the age of 18 this hour and whether states can deny them puberty blockers and hormone therapy.
The justices will consider gender-affirming care for transgender minors, which has been banned by Tennessee and 25 other Republican-led states. With its time running out, the Biden administration and families of transgender adolescents will appeal to the justices to strike down the Tennessee ban as unlawful sex discrimination. A lawyer for Tennessee will argue the procedures are risky and it's the state's role to protect children. Michael Toscano, CBS News, Washington.
Jurors in New York are beginning their second day of deliberations in the case of Daniel Penny, the man charged with choking a subway rider to death. CBS New York's Christina Fan from the courthouse.
If jurors convict Penny of manslaughter, they won't be asked for a verdict on the lesser charge of criminally negligent homicide. But if they decide he's not guilty of manslaughter, they will consider the second charge.
Penny claims he didn't mean to kill Jordan Neely, only to restrain him. Pete Hegseth's just arrived on Capitol Hill as multiple sources tell CBS News President-elect Trump may be ready to dump his embattled pick for defense secretary and replace him with Florida Governor Ron DeSantis, Republican Senator Lindsey Graham.
Some of these articles are very disturbing. He, obviously has a chance to defend himself here, but, some of this stuff is going to be difficult.
Hegseth is accused of sexual misconduct and excessive alcohol use. A new assessment finds U.S. kids are still struggling academically after the pandemic. CBS's Jim Krasula.
Math scores of American students took a bigger hit from the pandemic than their peers overseas. That's according to a closely watched international exam for students in 4th and 8th grades. Math and science scores of U.S. students weren't any better in 2023 than they were when the exams were first given in 1995.
The Dow is up 238 points. This is CBS News.
love.
Americans are having a love affair with an Irish beer.
I'm Vicky Barker at the Foreign Desk in London.
Myself and Ed are here backstage, and we're going to try and split the G.
Pop star Ed Sheeran with some local talent at a Dublin gig splitting the G, drinking a branded glass of Guinness till the line between white foam and dark brown beer hits the center of the Guinness label.
I think I did a pretty good job there. You've absolutely nailed it.
At one Irish-themed bar in Boston alone, Guinness sales are up 63%. The drink, technically a stout, riding a wave of interest in Irish culture sweeping the USA.
When it comes to pronunciation,
Kamala Harris gets in, and by the way, there are numerous ways of saying her name.
President-elect Trump got it wrong. So did a lot of others. According to the language learning company Babbel, Kamala is among the year's most mispronounced. So's the name of a certain pop star.
Chapel, not Chapel. Chapel Roan.
Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube as well. Lots of news crossing into tape here. Some business, some not so business here. ISM eco data just came out a little bit weaker than expected. We're going to break that down in just moments. We're also going to get a check-in with Caroline Conan. She is Bloomberg French TV reporter. Get the latest on the no confidence vote, which we're expected this morning coming out of Paris. Anurag Rana, Bloomberg Intelligence technology analyst. He's going to recap Salesforce earnings, and we can talk to him about anything on the tech front. We probably will. So we got a lot coming up. But first, let's check in with Steve Miller. He's the chair of the ISM Services PMI. Steve, thanks so much for joining us here. I'm looking at the ISM Services Index. Came in at 52.1. The consensus was 55.7 here. What are we seeing on the services side of the U.S. economy here?
You know, I think this month's number is a solid number. It's on trend. If you look past the last 2 months, in a couple of interviews that I was in over the last 2 months, I mentioned just as likely those blips in new orders and business activity, as well as supplier deliveries, could have been the result of the port strike, people getting ready, risk management around port strike and hurricanes, and those seem to be off trend. This one seems to be right on trend and continues to reinforce that slow to moderate growth in the services sector.
So the market is taking a little bit of a different view. If I just look at the front end of the yield curve, you're seeing a bid into the bond market yields a little lower. The dollar is dropping, and the S&P is off its highs. And I say that because it seems like the market is taking it as more weakness.
Okay.
Is that how you're describing it? Like continued weaker services grinding lower, or some sort of like, yeah, it's fine?
I think for the next 6 months, to me, it looks fine. It's on a trend of about 52%, which is a solid number, although lower than it's been in previous years. I think more the concern is when you look at the summertime, which in non-COVID years has been anywhere from 0.5 percentage point up to 6 percentage points down from where it is in the September to November timeframe. So I think in the near term, it looks solid. I'd be, there's so many variables out there around tariffs and interest rate changes and that type of thing, Fed rate changes. I think, I think the summertime is more the question mark.
All right, Steve, thank you so much. We appreciate that. Steve Miller, he's the chairman of ISM. That's the Institute for Supply Management, on Zoom from Aledo, Texas. How about that?